Hi students, welcome you all to the RTP session where we are discussing today the January 25 RTP. Now, give you a gist of little RTP. The RTP is very nice, fantastic. All the questions are very nice. We'll be solving in this entire session one by one each and every RTP question, and we'll have a complete idea of all the questions. So, starting with the first question of the RTP. And looking at the first question of the RTP, you might feel that question is very lengthy. It might be quite difficult, but no students. Some is easy. The only thing is that we need to read each and every part of the question properly so that we get all the answers correct. So let me start with the first case-based scenario. And what this case-based scenario wants to talk to us, let's have a look. We'll read the entire question. We'll find out the areas which are very important for us. We'll see the requirement part, and then we'll proceed ahead. As I say every time in the class, before solving the question, read the question well, because 90% or I can say 100% of your answer lies in your question only. So it's my request to each and every student who is appearing for the exam, keep your mind cool, read the question properly, because definitely while reading such a big question also, if such type of question do come in exam, then also I'm very much confident that if you read the question properly, and you keep yourself very calm and cool, of course, the entire question can be solved very easily. Okay, students? So we shall read the entire question for all. Have a look to the question. What does the question wants to talk to us? Yep, students. Sambar Limited, a leading FMCG company, having its current presence in more than 150 Tier 1 and Tier 2 cities in India. The stores are operating in the brand name of Go Mart, competing with Reliance Fresh, Walmart, Big Bazaar and other chains. Owing to increase in demand from the Tier 3 cities and rural areas, it is planning for massive expansion and is contemplating to open up additional 50 stores which will have a wide variety of FMCG products. Now, one thing what I understand, that they are into some retail business. They are simply traders. They are not the manufacturers. Okay. So we'll go paragraph by paragraph. We'll understand each paragraph and what important information we require. We'll collect the same from the question. Is it okay, students? Yes. So one thing what I understand from the first paragraph, reading the first basic paragraph, that they want to start a new store in Tier 3 cities. Okay. And they are traders, not manufacturers. Completely fine. So one thing what I understand, that they are traders. They want to open in Tier 3 city. Okay, not a problem. They are already established in Tier 1 and Tier 2, and they are having a close competition or a very good competition with Reliance Fresh, Walmart, XYZ. We don't care. So after reading this, my crux of the question is done. That we are a trader and we want to open in Tier 3 and the rural area. After that, this paragraph, I don't think so anything is important for us. So if the data is not important, kindly skip, so that we don't again see to this data. If while solving the sum, if we see this data again, we might get confused. So basic thing, once information is grabbed, leave it. Next, go ahead. The CFO and his team estimates that the funds required for massive expansion would be 200 lakhs. Yeah, this would be my something core thing. 200 lakhs per store. Okay. For one store, they will require 200 lakhs. Fine. Such funds will be utilized for buying out the space and setting up the stores, buying the other required fixed assets, etc. Central government will provide a revenue subsidy. Wow, something new for us. Will provide revenue subsidy of 15% on gross profit if the overall cost of capital does not exceed 10%. Now, what this paragraph is saying, that there will be a capital investment. Completely fine. And how much will be the capital investment, sir? Capital investment required 200 lakhs, nearly around 2 crores. And something revenue subsidy will get, but there's a condition. Revenue subsidy will be 15% of gross profit if the overall cost of capital is not exceeding 10%. These two things are important for me, except that nothing is important. So what is highlighted in yellow and capital investment of 200 lakhs, that is the main objective of the paragraph number 2. Done. Let's go to paragraph number 3. Apart from the above, means additional than the above, CFO and his team requires an estimate on the additional capital needed based for the smooth running of fixed assets and its daily operation. What I understand is capital needed for daily operations is nothing but your working capital. Yes, sir. That's my working capital, definitely. Okay. Based on the market research, they have collected the other information for each store, which is as follow. So my 3 paragraphs are done. First paragraph completely useless because I am just getting a basic idea that they want to open a store in tier 3 city and rural areas. Capital investment required 200 lakhs. They would get a revenue subsidy of 15% of the GP if the cost of capital does not exceed than 10%, and they would require additional working capital. So my paragraph 1, 2, 3 done. Come on, quickly, next paragraph. This is how you can read the question and solve the same very quickly if you know what to grab from the question. Okay. Average sales would be 120 lakhs per annum. Okay, this is important for me. Average sales would be 120 lakhs per annum with a GP margin of 18%. Completely fine. So one information we have of sales, one we have GP, and sales minus GP, I can also get COGS, just a rough idea. Normally, if I know the formula, I just speak. Yes, sales minus GP, if anywhere required, I have COGS also. Customer pay through different digital modes and channels, including POS system. Now, what is POS? Debit card and credit card. Okay, means customer can have an option of swiping their credit cards and debit card, which generally takes approximate 9 days for funds to get credited in the bank account. Now, normally what I understand, if I have a retail store, this is a retail store because it is an FMCG. Am I right? We saw very clearly that's an FMCG product, and is like Reliance Fresh, Walmart. So normally they have the business of cash. Am I right? We not normally go to Reliance Fresh, we pay cash, the company receives the money in cash. Means they don't get their money blocked in datas. But one thing what I understand, if the customer is using the debit card, credit card, they're swiping it, the company will get the money after 9 working days. 9 days from the 9 days, approximately 9 days for the funds to get credited in the bank account. So there is something like investment in datas. Yes, the money is getting blocked in datas. So for 9 days, our money will get blocked. And what they have told, 15% of the customer use debit card, credit card. All are not using this facility of debit and credit card. Out of 100%, 15% of the customers are using credit card, debit card to make the payment. Installing a POS system comes with a fee of 2% of total sales through POS. Okay, completely. We understand 2% will be the process charging with the company needs to bear. And one more thing, what I understand, my total sales is 120 lakh. My GP margin is 18%. Customers near around 15% are using this POS service. This money will be received after 9 days from the date of the sales or from the date of payment, will be received in the bank account of the company. And 2% is the charges which the company has to bear for making use of the debit card, credit card. Completely fine. The paragraph is done. Okay, I took the crust from the question. Fantastic. Being a FMCG outlet, inventories of multiple products need to be kept. Different products having different storage period. Oh, wow. That means in this paragraph, we'll get inventory storage period. Means for what period the inventory has been stored. Of course. However, primary products are classified into 3 broad categories: durable, semi-durables, and perishable. So 3 things I have identified, that they have 3 types of products. One is durable, second is semi-durable, and third is perishable. These are the 3 main categories of products what they kept at their FMCG store. Perishable product comprises 60% of sales. Wow, there's something new for me. Out of the total sales, 60% is comprising by perishable, whereas a semi-durable is 25% and the balance is durable. If 60% is perishable, 25% is semi-durable. So I can conclude over here that 15%, 60 plus 25, 85, 15% balance will be my durable products. Okay. Inventory storage for perishable, semi-durable and durable are 10 days, 30 days and 60 days. As I rightly told you that there is an inventory storage period. This 10 days, 30 days and 60 days, I shall use this data wherever required. Because I have learned in the chapter of working capital that there is an inventory holding period. Even in working capital only I have learned there's investment in debtors, money gets blocked in debtors, that might help us to find out the working capital. Because we have just read in the earlier page that company requires working capital. So after reading this paragraph, I come to know they have given us investment in debtors, means a blockage of money in debtors, as well as holding period is given of this stock, means we would need to find out the working capital with the help of this information. Students, my mind starts working as I see the information. In the earlier paragraph, they have told about working capital, but the amount of working capital is not given. They have given the amount of capital investment, that is 2 crores. But working capital amount has been not provided by the question, means the question wants to find out the working capital requirement. Because further information what is given, that is investment on debtors, and there is investment in your stock. So 2 things they have already given us as a hint. This might help us, definitely might help us. So means I am expecting that the question is asking us to find out the working capital. Let's see ahead. Requirement. Suppliers of this product provides a credit period of 30 days. It is creditors payment period. Wow, we are heading towards the right area. This is the creditors payment period. We need to pay creditors after 30 days. This is a time given by the creditor. This is fantastic. This will help us. Now what is next? Each store will employ 20 personals, okay, of different hierarchy. Of course, staff is required. And monthly average salary to staff of each store, see the words properly, is estimated to be 4 lakhs per annum. So means one store will cost a salary of 4 lakh for the entire store. Per store they are given, each store average salary to staff for each store will be around 4 lakhs per month of each store. So means I can say 48 lakhs will be my annual salary of one store. Okay, we'll write down over here annual salary for each store. Annual salary for each store will be rupees 48 lakhs. So 4 lakh is for one store for 1 month. So for 12 months it will be 48 lakhs, and the company will pay employees due on the first of the next month. Means there is outstanding wages. Company is paying after 30 days of completion, wages are paid. So there is a lag in payment. What I understand from this, company will pay employees due on first of the next month. Completely nice. So 1 month there is a due outstanding wages. This also helps us in calculating the working capital. Now, Somewhere Limited plans to keep optimum cash balance. Oh, as I see the optimum cash balance, I remember the cash budget chapter in which there is a William Baumol's model which helps us to calculate optimum cash balance. So till now I know that only. In our entire syllabus, to calculate optimum cash balance, we know Williams J model, Baumol's model, which is there in your cash budget chapter. Okay. Somewhere Limited plans to keep optimum cash balance in hand as suggested by Baumol's model. Oh, definitely. Excess cash balance, if any, will be invested in the marketable securities, which will generate a return of 12% per annum. The total disbursement for the year, for the year is estimated 1.5 lakhs per month. Okay, per month. And in Baumol's model, we require annual cash disbursement with a transaction cost of 20 rupees per transfer to the disbursement account. Perfectly nice. Now, what is next? We went little down. Wait a moment. So here what I need to find out is my optimum cash balance. One thing I'm writing down, that with each paragraph what I can find and what the paragraph can help me to find. Completely fine. The optimum capital structure. Lovely. Second time the word optimum. The first time the optimum word was in your optimum cash balance. Optimum cash balance, of course, cash balance chapter, Williams J. Baumol's model. Now, optimum capital structure, as we have studied in the class, and students of Ednovate very nicely properly knows one thing, that optimum capital structure is a capital structure. If I want to define optimum capital structure, just recapping the concept, optimum capital structure means that capital structure where EPS or MPS is maximum or the WACC of the company is the minimum. Am I right? So that's the optimum capital structure, definitely. The optimum capital structure with debt equity of 2:1. They have told us the proportion of debt and equity. So company wants to maintain a debt equity ratio of 2:1, 2 for debt, 1 for equity. Nice. Has been proven ideal for raising the funds. Now why it would be ideal? Because either the EPS or the MPS would be maximum, or the WACC or KO will be minimum. Because either the cost can be low or the market price can be the high. And that will be the optimum capital structure. Do remember, if it comes in exam also, whenever the question asks you to find out the optimum capital structure, means either you need to find out the EPS or MPS as maximum as per the information provided in the question, or you need to find out the lowest cost, that is WACC should be the lowest or the KO should be the lowest. Yes, students. Has been proven ideal for raising the finance, and the company wishes to follow the same pattern for additional fund requirement for each store. Trade credit can also be utilized for financing the expansion need. Okay. Now the cost of raising the debt and equity for each store is as per the slab. Wow. One question and so many informations. I like it, man. This is giving me a recap of the many major chapters of the syllabus. Okay. Now there's slab wise costs for raising the funds. Cost of project, cost of debt, minimum rate expected by equity. When we say about minimum rate expected by equity, this is expectation of equity which will become cost to the company, which is nothing but the KE, cost of equity. Up to 80 lakhs, above 80 lakhs but up to 150 lakhs, okay. Above 150 lakhs but up to 250 lakh and above 250 lakh, they have given us the rate of interest and the cost of equity. I understand one thing, the optimum capital structure as we already defined, EPS or MPS will be maximum or WACC will be minimum. That means here we have no details to find out the EPS and MPS, but one thing is for sure, I can find out with the help of this KO, that is WACC. And if I am able to find out KO, and KO will be minimum at the optimum capital structure. Fantastic. Question is really very nice. Okay. Now what this asterisk mark says, where was the asterisk mark? Sir, it was asterisk mark in near to the cost of project costs. Now what is saying, it means that up to 80 lakhs of the project cost, company can raise company can raise debt at 10%. And this 10% is nothing but the rate of interest. Means if I want to raise up to 80 lakhs, there's a proportion 2:1. So 80 lakh into 2/3, that is the amount of debt, and on that debt I need to pay 10% rate of interest. But KD is always after tax, don't forget students. So there might be tax rate and we'll find out KD. This is rate of interest. Rate of interest is always pre-tax, before tax, and KD will be always post-tax. And for WACC we always require KD after tax. Am I right? So it means that up to 80 lakhs of the project, company can raise debt at 10% and equity at the rate of 12.5% and so on. Tax rate applicable to the corporate is 25%. And I can see a question comes at the end, at least finally. 2 sides full length question. But many things we have sorted out. Don't you agree? We have sorted out many things. We have wrote many things. And just now what I want to do is have a look at the requirement part. Once you have a look at the requirement part, you will come to know that what we need to do. So what is the requirement of the question? We have done a complete postmortem of the question. Now let us see. I can see 1, 2, 3, 4, 5. 5 questions are asked on the basis of above case study. Now what are the 5 questions? Let us see. Based on the above details, calculate the following for each store. What to calculate for each store? The optimum cash balance. Completely fine. We can find out. Since I have a paragraph to find out optimum cash balance. Yes, sir. There's entire one paragraph on Baumol's model. Yep. I can find out that. Completely fine. Now what they have asked us next? The gross and the net working capital for the next year. Yippee. We were discussing that only while reading the question. That question will definitely ask us to find out the working capital, because nowhere in the question they told what is the amount of working capital. Definitely we need to find out the working capital. Okay. Third, the amount of total fund needed to set up a project. Okay. Third, the overall cost of capital for raising the additional fund for setting up the store. That is nothing but my KO. And that also I told you that we need to find the KO. And the amount of revenue subsidy, wow, the amount of revenue subsidy granted by central government and central government will grant me subsidy only if my KO is less than 10%. So by default, I need to find out KO. If my KO is less than 10%, I'll get 15% of the gross profit, of the gross margin. Wow, everything is sorted. Everything is sorted, guys. Fantastic. So my complete picture is clear what I need to do in the question. Am I right, boys and girls? Say yes or no. So let us start solving. The first thing what they've asked is to find out the optimum cash balance. Now students, we know the formula of the optimum cash balance as per William J. Baumol's. Yes or no? The Baumol's formula to find out the optimum cash balance is similar to the formula of your EOQ, that is economic order quantity, which you have learned in your material costing chapter. Now what is the formula of over here to find out the optimum cash balance? Optimum cash balance is equals to root 2 root 2 UP upon S. Now what is U? Annual disbursement. P stands for transaction cost per transaction. S stands for opportunity cost. Now the students who don't know the concept of William J. Baumol's with respect to optimum cash balance, what does it want to say? See, a certain amount of money is required to be kept in the cash box. If you keep any amount over in this, you will lose an opportunity to earn on the same. Second, if you keep very less cash in the cash box, then the smooth operations of the business will be affected. So you cannot keep a very high amount in your cash box. Neither you can keep a very low amount. If you keep a very low amount, then what amount you have invested is required to be withdrawn before the maturity. And if you do that before maturity, or if you redeem it at maturity, there's a transaction cost attached to it. So what does William Baumol says? You have to keep a certain amount of cash in your cash box for the smooth maintaining of the business. If you have excess cash, kindly invest in the market as marketable securities, which can be encashed very easily. Or if you keep the amount below this, then it will affect your working capital. So your formula is root 2 U P upon S, and P stands for transaction cost per transaction. U stands for annual disbursement. Now, what is our annual disbursement? We'll look at the question. We have the entire paragraph of optimum cash balance. And what does the question says? Their monthly disbursement are 1.5 lakhs. Okay. So the monthly is 1.5 lakh. For 12 months, it will be, if I'm not wrong, 18 lakhs. Completely fine. So we'll write down over here. The annual disbursement is 1.5 lakhs into 12 months, which will come to 18 lakhs. Transaction cost per transaction is how much? So the transaction cost per transaction, as we saw in the question, is 20 rupees is my transaction cost, the transfer fees. If the investment are being redeemed before the maturity, or they are redeemed, of course there will be transaction cost like brokerages. Transaction cost has to be borne by the company, and the opportunity cost of capital is 12% per annum. If I'm not wrong, students, say yes or no. So if I'm keeping surplus money in my cash box, I'm losing an opportunity on the same to earn, and I want to keep that much only cash, which is optimum for my business. So putting all these variables in the formula, root 2 into 18 lakhs into my P is transaction cost 20 and my opportunity cost is 12%. So if I use this formula, 2 into 18 lakh into 20 divided by 12% root, I'll get something 24,495. I should get the same answer, and you should also get the same answer, because that's the same answer reflected by the ICAI. The fourth option is correct. So we'll get 24,495 rupees. This is the minimum cash balance which is required to be kept in the business for the smooth operation of the business. I think so the part 1 of the question is very nice and properly clear. Since we read the question properly, the part 1 is easy to solve. Don't you agree, students? Say yes or no. Am I right, boys and girls? Now going ahead to the second part. First part is very easily and properly done. We have calculated the minimum cash balance or the optimum cash balance. Optimum cash balance is the minimum cash balance also, which is required to be kept in the business for the smooth operation of the business. Now going to the second part. What does the second part of the question says? They have asked you to find out gross working capital or the net working capital. First, do understand properly what do you mean by gross working capital. if anytime in the question they ask you gross working capital, means it is your current assets, and net working capital is your current assets minus your current liabilities. Simply, they have asked you to calculate the working capital. So we'll do estimation of working capital. Am I right? And we know properly estimation of working capital is nothing but your current asset minus current liabilities. That is gross working capital minus current liability, which will derive you the net working capital. Okay. Now, as I know properly, what comes in current asset? Current asset will have only 4 items: stock, debtors, cash and bank balance, and prepaid expenses. Throughout the question where I have read, there are no prepaid expenses. So 1 item is less. Okay. In stock also, normally stock are of 3 things: raw material, finished goods, and WIP. Since this is a trader company, it is trading goods and goods. It is not involved in manufacturing. We read in the first paragraph, this is a trader. So since it is trader, they won't have the stock of raw material, they won't have the stock of WIP, they will only have the stock of finished goods. So this is the power of reading the question. When I read the first paragraph, I understood very clearly it is a trading company. So what is the best part of the trading company is that they don't have a stock of raw material, they don't have the stock of WIP, they will only have the stock of finished goods. Means 1 item will come in your current asset, that is the stock of finished goods. Fantastic, very nice, superb. Second, what they will have? Of course, there will be debtors. Now, normally what happens, students, FMCG do not have any investment in debtors. There is no blockage of money in debtors because every business is on cash basis. So debtors are not possible. Then debtors are possible when there is a credit sales. But in FMCG companies like Reliance and Walmart, they have the cash transactions. The business is on cash. But however, there's a problem over here. So what is the problem? All my sales are not on cash basis. Some percentage, 15% of my sales are done by debit card and credit card, and that money is not reflected in my bank on the same day. That money is received in my bank after 9 days. So that means my 9 days there is an investment debtors, students, and that is why here we will have debtors. If there was no point of debit card, credit card, of course debtors would not come only because every transaction would be in cash. What a beauty of question. Never we have seen such type of thing in the module. The person who has drafted the RTP has drafted very nicely. Very good. And third thing which will come is cash balance. So where will you get the cash balance? Just now in the part 1 we have calculated the minimum amount of cash balance, that is 24,495. I'll quickly write down first thing over here. Minimum cash balance 24,495. The thing which we have calculated is useful over here. Am I right? Okay. Now means I need to find out the value of finished goods. I need to find out the value of debtors. So I'll get my total current asset, which is my gross working capital. Okay, what does it comes in current liabilities? I understand in working capital, in current liabilities, I get 2 items normally. One is creditor for purchases. Yes, of course, we have purchased the stock. Am I right? This FMCG company is not a producer. That means they are purchasing from someone. And we read in the question, the creditor is giving us 30 days credit. So there will be one creditors, and of course there is outstanding salaries. Remember, we pay after 30 days, next of the first month. So that outstanding salary will be my current liability. And when I'll do current asset minus current liability, I'll get my net working capital. So let us find out. First, we find out the value of finished goods. So let me prepare for you all working note number 1. Let us come to working note number 1. We'll find out the value of finished goods. I have kept few things ready for you so that we can revise these things very quickly. First thing, finished goods are always valued at cost of goods sold. Am I right or am I wrong, students? Say yes or no. Stock of raw material, a quick revision of the working capital. Stock of raw material is valued at raw material consumed. WIP is calculated at 100% of the material cost and 50% of labor and overhead costs. Finished goods is valued at cost of goods sold. Debtors are valued at total cost. Since we follow the cash cost system, if the question is asking you total cost basis, and the debtors will be valued at sales or selling price. This is how the quick revision is done. Am I right? Yes, students. So of course I need to find out first COGS, because I need to value my finished goods at COGS, and I know my sales. Somewhere I saw, yes sir, I saw in the second paragraph, sorry, first paragraph of the side second. There is annual sales of 120 lakhs. Okay, fantastic. I'll write down over here. My annual sales are 120 lakhs. And I have a gross margin something of 18%. Yep, I have a gross margin of 18%. So of course I can get my COGS. So 120 lakh minus 18%, I'll get somewhat around 98 lakh 40,000. Students, do calculate with me. Do you also get the same answer? You will get COGS of 98 lakh 40,000. This now in this sales of 120 lakhs, 1 crore 20 lakhs, 120 lakhs. Entire sales is not because of one product. There are three products. One is durable, semi-durable, and perishable. And we have seen what are the proportion of them. The semi-variable is comprising of 25%. Okay, so write down semi-variable is comprising 25%. Then we have got something with respect to 60% of sales are for perishable. Perishable comprises 60%. So we'll write down in front of perishable 60% and 15% is for durable. Just a second, I have written in the wrong area. Durable, it is for 15%. Here I need to write down. Semi-durable, it is 25% and 60% is for perishable. So if I want to find out value of inventory, whenever we find value of inventory, I require the value multiplied with the holding period. We also have the holding period of each of the product, 10 days, 30 days and 60 days. So we will value at COGS. So out of 98 lakh 40,000, 15% is for durable. Out of 98 lakh 40,000 into 25% is for semi-durable, and 98 lakh 40,000 into 60% it will be for perishable. Let us find out the amount. 98 lakh 40,000 into 15%, that will be 14 lakh 76,000. Do you agree? 25% will be 24 lakh 60,000 and 65% will be 60,000 will be 60% will be 98 lakh 40,000 into 60% will be 59 lakh 4,000, and this will come to total of 98 lakh 40,000. So my finished goods has three components. One is durable, semi-durable and perishable. Now this is the value of each of them. We have holding period of each of them. Now what is the holding period? So the holding period is, I think so, 10 days, 30 days and 60 days. Am I right? Do you agree, students? Am I right or am I wrong? Yes, there are 10 days, 30 days and 60 days of each individual. For perishable it is 10 days, for semi-durable it is 30 days and for durable it is 60 days. So perishable 10 days, 10 divided by 360 days. For why we have taken 360 days? Because if you see, there is average 30 days of credit period given. Here we are assuming that a year of 360 days, and in FM we do assume a year of 360 days. Semi-durable, there is a inventory storage period of 30 days. So 30 divided by 360, and for durable it is nearly around 60 days. So 60 divided by 360, we will multiply with each individual value so that we will get the value of inventory with respect to finished goods. I think so, students, it will be very easy. If we know every concept very nicely and properly, it won't be difficult for any one of us. So we'll write down for durable, it is 14 lakh 76,000 into 60 divided by 360. Semi-durable 24 lakh 60,000 into 30 divided by 360, and 59 lakh 4,000 into 10 divided by 360. 14 lakh 76,000 into 60 divided by 360 will be 2 lakh 46,000. Then 24 lakh 60,000 into 30 divided by 360 will be 2 lakh 5,000, and 59 lakh 4,000 into 10 divided by 360 it will be 1 lakh 64,000. So if I find out the value, if I add up the same 2 lakh 46,000 plus 2 lakh 5,000 plus 1 lakh 64,000, the value of inventory will be 6 lakh 15,000 with respect to finished goods. Finished goods are always valued at COGS. You find out the value of COGS, multiply with the Holding period. Here we had 3 items, so we need to split up to the COGS on the basis of proportion. As simple as that. I got my first answer from my first working note, that is 6,15,000. I'll simply write over here 6,50,000 is my value of finished goods. Oh, first thing done. Now second, I need to find out the value of debtors. And to find out the value of debtors, only one thing I need to do. Since all my sales are on cash basis only, and only 15%, only the 15% is on credit basis. Am I right? Am I wrong? So how to find out? Let's see together. Am I right, students? Say yes or no. So how to find out the value? 15% is on credit basis. So debtors are always valued at COS. Am I right, students? Say yes or no. Now how to find out this? I have COS will be how? It will be COGS plus the POS transaction. Now what is this POS transaction? The amount incurred, the transaction fees which are being incurred for making the sales, the 2% transaction cost. Am I right? So my COGS is 98,40,000. I don't have any other selling expenses, general administration overhead expenses. Question has been completely silenced on the same. I have only sales figure, I have only GP margin. So with the help of sales and GP margin, I was able to calculate COGS. And I'll add up the transaction fees, so I'll get the COS. Normally when we used to prepare the estimation of working capital, we used to find out the cost sheet, and cost sheet we used to find out the COS, because COS becomes my total cost. But here, since I am having no other information, I know sales minus GP is my COGS plus the transaction cost. Now how much is the transaction cost? Out of 1 crore 20 lakhs. Only 15% is my credit card, debit card usage. Even in COGS, I'll multiply 15%. So why into 15%? See, COGS is for entire one. My COGS of 98,40,000 is for entire 1 crore 20 lakh sales. But my entire sales is not by debit card, credit card, only 15%. So I'll take the COGS proportion of 15% only. I won't take the entire COGS, because if I take entire COGS, it's for the entire sales of 1 crore 20. I'll just take a part of the cost, that is 15%. Even I'll take a part of a cost of 1 crore 20 into 15% of the total sales into 2% my transaction cost. And when I find out the amount, 98,40,000 into 15% is 14,76,000 plus 1 crore 20 lakh into 15% into 2%, you will get 36,000, and this will be the total amount of your COS, which is total cost, and it will be how much? 14,76,000 plus 36,000. This will be 15,12,000. This is the value which is invested in my debtors. This is my investment in debtors, the amount which is blocked in debtors at total cost. So it will be 15,12,000, and this is being stuck only for 9 days. So it will be 9 days divided by 360 days. 15,12,000 into 9 divided by 360. I got 37,600. Sorry, 37,800 as my value of debtors. So I got my second figure also. I got my first figure, that is value of finished goods. Second, I got my value of debtors, that is 37,800. I'll write down in my working capital 37,800. I have the minimum cash balance of 24,495. Boss, I'm ready with my answer of working capital. It will be 6,15,000 plus 37,800 plus 24,495. It will be 6,77,295. This is nothing but your gross working capital which was asked in the question. First thing, we are ready with it. We are ready with our gross working capital of 6,77,295. So now let us find out the current liabilities. Now in current liabilities, so what do we have? We have creditors for raw material. Sorry, not for raw material, creditors for finished goods. And one thing I want to highlight over here, if you have read very properly the question, say it is not a newly formed company. But in tier 2 and tier 1, it is already established. But in tier 3, it is a newly formed company. Students, keep a proper note over here. Whenever we are solving the questions on working capital, whenever in exam, whenever we are solving the questions of working capital, if it is a ongoing business, creditors will be valued at DRMC. What, sir? Creditors will be valued at DRMC, that is direct raw material consumed. Because here opening stock and closing stock is valued same, and thus DRMC is equals to purchases. This is a short revision for the students who are solving the sums on working capital, practicing the working capital on the day of exam. Don't forget, if it is an ongoing business, see, I know here the business is ongoing, but there's a new store. New store means newly formed company, or I can say newly start business. In tier 3, there's a new store, and each store will have their own inventory, own stock. Boss, do understand, this is a small trap. If you don't consider this properly, then you will be in the great trouble. If it is ongoing business, always your creditors will be valued at DRMC is equals to purchases, because we consider opening and closing stock will be same. It is the ongoing business, opening stock, closing stock remains same. However, here it is not an ongoing business. It is a newly set up in tier 3, a new store, and it will be considered like a newly formed company, or a newly formed business, or a newly formed store. And therefore, here while solving the working capital problem, when there is a newly established business, newly formed business or established business, creditors will be always valued at purchases, because opening stock is not there. There will be closing stock. Here the opening closing stock will not be same. You need to find out the purchases figure. Students, do not do such type of mistakes in exam, and that is why I brought an important point over here while calculating working capital. This is an important area to be noticed, to be monitored. So don't forget to make a quick recap of the same. Do write down in your important points, LMR, LDR, wherever you want to write. Put a sticky note so that you don't do the same mistake in exam. And if you have already understood this, nothing to worry. Am I right, students? Say yes or no. So let's find out the value of creditors. One thing I have understood, that this is the same sum like newly formed company. I'll value my creditors at purchases, and for that I should know that what is my purchases figure. Now, of course, opening stock will be the nil, so I'll write down. Do you know the formula of COGS? Yes, of course we know. COGS is equals to opening stock plus purchases minus closing stock. My COGS is 98,40,000 if I'm not wrong. Just now we have calculated. Opening stock is nil. Purchases we need to find out. And sir, where do I get a closing stock from? Of course, right now I have calculated the value of inventory. That is the closing stock. So it will be 6,15,000. And therefore purchases for the year will be 6,15,000 plus 98,40,000. The total purchases is 1,04,55,000. Students, do check. And creditors are giving me 30 days credit. So how do you know? We have read the line. Have a look, Bacha gang. We know in this paragraph only. 1 second. Yeah, the creditor payment period we already wrote. 30 days is the credit period which is given by the creditors. So simply I'll write, therefore value of creditors will be 1,04,55,000 into 30 days divided by 360 days. It will come to, I think so, 8,71,250. Since I got the answer, I'll simply write in my working capital. Yes, students, it will be 8,71,250. Now coming to the last item to find out your working capital, outstanding salaries. See, we saw that there is 48 lakhs of salary in the entire year and 1 month is outstanding, because we are paying after 1 month. So of course, on the first day of the next month. So if I'm not wrong, if I want to find out the value of outstanding salary, I'll say 4 lakh is my salary for the per month into 12 months. Excuse me, into 12 months, it will be 48 lakhs and is outstanding for 1 month. So into 1 month divided by 12 months, of course, I think so it will be 4 lakhs. So this is my amount of outstanding salary. I'll write down in my outstanding salary as 4 lakh, boys and girls. Am I right? And I'll get the total figure for my current liabilities. It is 8,71,250 plus 4 lakh. It is coming nearly around 12,71,250. And to my notice, to my surprise, my current assets are less than my current liability. I have a negative working capital. Wow. And how much will be my negative working capital? 12,71,250 minus 6,77,295. I have 5,93,955 as my negative working capital. So this is the answer which is there by ICAI also, and your right answer will be, they have written rupees in lakhs. They have written rupees in lakhs, so I also need to write down rupees in lakhs. And to find out gross working capital, it is 6,77,295 divided by 1 lakh. If I do, it will be 6.7730. Yes, 6.7730. And net working capital, which is negative, it will be 593,955 divided by 1 lakh. It will be 5.9396. Yes, sir. They have rounded up one digits. This is rupees in lakhs. And if I'm not wrong, the option 1 is correct. The option 1 has the right answer. The negative working capital will be in brackets negative. Option 1 is the right answer. In case of minimum cash balance, I had the right option as option 4. Am I right? Here my option 1 is correct. And how simply and easily we have calculated such a big area into a small bit and size. Lovely, fantastic. Very nice. Now after this is done, what is the third thing which is asked by the question? Let us have a look. The third thing which is asked, calculation of amount needed to set up the store. Now what is the amount needed? Total amount requirement. Let me write down the total amount requirement. Very easy. So I saw that we require capital investment of 200 lakhs and we require working capital, but my working capital is negative. So what will be my total amount requirement? I'll write down capital investment plus the working capital. Capital investment is 200 lakhs and working capital will be minus because it is negative. Lakhs is how much? 5.99. How much we calculated just now? 5.9396. So minus 5.9396. 5.9396 negative 200 minus 5.9396. It will be somewhat 194.0604 or 05 lakhs. Since rounding up, it will be 194.0605 lakhs. And here again the option 1 is correct. Two things are required for capital investment. One was your capital investment, second was your working capital. Since we have negative working capital, the amount will be required less. Thank you for my creditors. Thank you for the outstanding wages, which has reduced my working capital. Very nice. So we are done with part 1, part 2, part 3 of the question very easily and smoothly. Now coming to the part 4 of the question, which is asking you to find out the KO, that is the overall cost of capital. Now this is little tricky, but even though it is tricky, if we understand things properly, there is no tension to us. Excuse. Now what does the question says about cost of capital? Thus, they are saying that the slab rate is up to 80 lakhs. They have told something, if I'm not wrong, the question has told very clearly. Up to 80 lakhs, above 80 lakhs, up to 150 lakh, above 150 lakh, up to 250 lakh, and above 250 lakhs. There is different rates. Now, one thing what we need to properly observe over here, that there is an optimal capital structure and they want the debt equity mix or debt equity ratio of 2:1. So we need to maintain that. So why we need to maintain that? Because it is an optimum capital structure. Boss, we cannot touch that at any cost. Company wants its optimum capital structure, and for that they want the debt equity mix as 2:1. I need to maintain the same. Okay, completely fine. I'll keep debt equity mix. My amount requirement is 194 point how much? 06. 0.05. Am I right, boys and girls? Yes, sir. Your amount requirement is just only, it is 196.0605. And I have to keep a debt is to equity as 2:1. Okay. Now, as an Ednovate student, and the students who are not a part of Ednovate, but right now you have become a family of Ednovate by watching this video, we have a table. And what is a table? We normally, for calculating WACC, cost of capital, overall cost of capital, we write down sources of finance, amount, cost percentage, weight proportion, that is weight per percentage or proportion, and the WACC. And so every student needs to follow this, because this will make your sum easy. Now weights will be, so it is 2:1 ratio of debt and equity. Debt will be always 2 and equity will be 1 as what is given in the question. And if I am not wrong, 2 divided by 1 will be 0.67 if I am not wrong, and 1 divided by 3 will be 0.33, means it will be 66% and will be 33.3%. So what will take? We'll take 0.67 as debt proportion and we'll take 0.33 as equity proportion. Now one thing what we need to write down over here, cost percentage. Debt, when it is up to 80 lakhs, watch it properly, when it is up to 80 lakhs, I am getting a rate of interest of 10%. Sir, how do you know? See here, they have told the rate of interest is 10%, and if I am not wrong, our tax rate is 25%. So my KD will become 10 minus 1 minus 0.25, 10 into 0.75 will be 7.5%. My equity cost they have given us directly up to 80 lakh. My cost of equity is 12.5%. So I can directly write here 12.5%. So it will be 0.67 into 7.5%. It will be 5.025%, and here it will be 0.33 into 12.5%. It will be 4.125%. Total will come to 9.15%. Am I right? If it coming to 9.15%, now what we'll do? What is the total cost? See, up to 80 lakhs, I'll incur a cost of 9.15%. So the total cost will be 80 lakhs into 9.15%. The total amount which will be incurred by the company will be 80 lakhs into 9.15%, which will be 7.32 lakhs. Means to get a amount of 80 lakhs, we need to pay from our pocket. The company needs to pay from our pocket 7.32 lakhs. Do you all agree? Now anything above 80 lakhs, that is above 80 lakhs, but up to 150 lakhs. See, we require total amount of 194.6065. So of course, we need to go up to 150 lakh. Again, we'll write down the debt proportion will be 0.67. Equity proportion will be 0.33. For the next slab, this is going slab by slab. If you understand properly, see, normally in our other sums of module and everywhere, there were no slab rate with respect to this. But here there is slab rate. I require 194.6065. 0605. So it is over and above 150 lakhs. We won't go to the fourth slab because fourth slab is about 250 lakhs. We'll be stopping at the third slab above 150 lakhs. So slab by slab I need to calculate. Up to 80 lakh, how much cost I'll need to incur. Up to 150 lakh, how much cost will be incurred. Because here I am additional 70 lakhs borrowing. This additional borrowing of 70 lakhs. Additional fundraising of only 70 lakhs if you understand properly. Up to 80 lakhs, I will borrow and I'll incur a cost of 7.32 lakhs. For additional 70 lakhs, there will be an additional cost. I understand, students. This is same what we used to do in class for capital structure, but the numbers were very small. Here the numbers are quite big and little tricky. The ICAI has kept nice bar over this question. Benchmark has been set. Now you know this sum, even if it comes in exam, you should not at all worry about it. Do you agree, students? Say yes or no. It's a fantastic sum. I loved it. Hope so you also love the same. So when we are raising above 80 lakhs but up to 150 lakhs, my rate of interest is 11.5%. If I'm not wrong, students, correct me. Yes, it is 11.5%. So we'll write down 11.5%. I can directly write into 0.75. So 11.5% into 0.75 will be 8.625, and the cost of equity is how much? The cost of equity is 13.5%. So I can write down directly over here 13.5%. And if we multiply, what will be the answer? 0.67 into 8.625 percentage. It will be 5.77875%, and 0.33 into 13.50 percentage. It will be 4.455 percentage. A total comes to 5.77875 plus 4.455, which will be 10.23 or 24. 10.24%. I'll take 2 digits. Now for this additional 70 lakhs, how much cost will you need to incur? 70 lakhs into 10.24%, 70 lakhs into 10.24%, which will be 7.168 lakhs. Are you understanding? If I want to borrow 80 lakhs, comprising of debt and equity, from my pocket, I need to incur a cost of 7.32 lakhs. For the next additional 70 lakhs, comprising of debt and equity, I need to pay from my pocket 7.168 lakhs. And then now the last slab, total 150 raised. Total 150 raised. Now what is remaining? 194.0605 is the total amount required. So it will be minus 150 lakhs. You will require only the balance 44.06. 44.0605. This is 194.0605 minus 150 lakhs. Up to 150 lakhs we have borrowed in the earlier 2 slabs. 80 lakhs of the first slab, second slab of 70 difference, and the remaining difference of 44.0605. Here also there is a debt equity mix. There will be debt, there will be equity. Of course, the equity proportion will be 0.67. Sorry, debt proportion will be 0.67 and equity proportion will be 0.33. Now, what is the cost over here? The rate of interest is 12%. So we'll write down 12 into 0.75. After tax KD will be 12 into 0.75 will be 9% exact. And what is the cost of equity? Of course, 14% as given in the question. Let us multiply the same 0.67 into 9%. It will be 6.03%, and 0.33 into 14% will be 4.62 percentage. Total will come to 10.65 percentage, and 10.65 is the cost for raising 44.0605 into 10.65 percentage, which will be 44.0605 into 10.65 percentage will be 4.70 lakhs. So if you see, total funds raised are 194.0605 lakhs, and the total cost incurred will be the 3 amounts. Up to 80 lakhs, it was 7.32, perfectly right, 7.32 lakhs, plus for the remaining next additional 70 lakhs, it will be how much? 7.168, yes, of course, plus 7.168, and the remaining it will be 4.70 lakhs. A very different sum, but fantastic. I liked it, really nice. So what is the total? 7.32 plus 7.168 plus 4.70, total will be around 191.88. This is the cost which is incurred by the company for raising 194.0605. So what is the total cost incurred by the company will be divided by 194.0605 into 100, it is coming nearly around something 9.90, nearly around 9.90. Due to rounding up, you will get something around 9.89 or 9.88, but it is coming nearly around to 9.90%. And to have good news, this is your KO, which is less than 10%. Yes, the company is eligible for the subsidy. Superb. See here also the option, I think so. Which option is right? The option C is right. The option 3 is right. 9.90 you will get the answer. Nearly around you will get 9.89 due to rounding up because there are many decimals. So the nearest answer, I don't see any other answer which is as close as to 9.90. Others are 8.91. Of course, it is not there. 10.65, 10.01, and you will get 9.90 as the right answer. So what will my value of subsidy now? My value of subsidy is, it is first of all revenue subsidy. Students may ask me a doubt, hey, boss, sir, why this is not reduced from the capital investment? It is not reduced from the capital investment since it is a revenue subsidy. It is not a capital subsidy, for your kind information. If it was a capital subsidy, we would have reduced from the value of the capital investment. Your capital investment would be less than 200 lakhs. Boss, again, one more point to be noted. Since it is a revenue subsidy, we are not reducing from the value of your capital investment. Your capital investment is 2 crore. If the question would have provided capital subsidy, yes, definitely the capital subsidy would have been reduced from the cost of the investment, capital investment. So what will be the value of subsidy? They have told 15% of gross profit. This is the fifth and the last final item what they have asked. Such a big question, but very easily solved. Many things we have covered. 15% of the gross profit. What is my gross profit? Sir, it is 120 lakh into 18%. So if I am not wrong, it is 21 lakh 60,000. And if it is 21 lakh 60,000, this is my gross margin into 15%. We will get a revenue subsidy of 3 lakh 24,000. And if I want to find out in lakhs, divide by 1 lakh, it will be 3.24 lakhs. And I think so some option is right. And which option is right? We need to check. The 3.24 lakhs is the option number B given in the question. Hooray! A big question, but hope so you have understood every bit and size, every small things of the question very nicely and properly, students. Am I right or am I wrong? Yes, boys and girls, am I right, students? Say yes or no. Definitely each and every item of the question is properly understood to you all. This is how this big questions can be very easily solved by each and everyone. So let us go to the second question. Yes, students, we have nicely and properly calculated the entire 5 requirements of the question number 1. Now let us go to the question number 2, which is on your dividend decision, if I'm not wrong. A very small question and a very easy MCQ. Pray to God, such type of MCQs do come in exam. It's very easy, damn easy. Actually nothing. You might just solve in next 2-3 minutes. Let's have a recap of the same. The cost of capital of the firm. The cost of capital of the firm is 12%. It's expected. Expected means to be. Earning per share, that is EPS, at the end of the year will be ₹20. Its existing payout ratio is 25%. And the company is planning to increase its payout ratio to 50%. What will the effect on the change on the market price of the equity share of the company as per the Gordon's model? If the reinvestment rate of the company is 15%. Now reinvestment rate is nothing but your R, that is ROI percentage, return on investment. That means if the company is investing the money in the business, it is getting damn minimum 15% return on the funds investment, on the funds invested. Now what is this 12%? Of course it will be K. Sir, why K? Because they have wrote over the cost of capital, and cost of capital comprises KD, KE, KP, KR. But boss, here no information is with respect to KD, KP, KR. Of course, so here the cost of the firm is nothing but the K, the amount invested by the equity shareholders. And I need to find out the change in market price due to change in dividend payout ratio. Very simple, I need to find out the intrinsic value of share. It will be 2 minutes for us to solve because we know this very nicely and properly. This is your question number 2 with respect to dividend decision. Now I want to give you small 2 LMRs over here, last minute revision. Don't forget this. 2 small things with respect to dividend decision. Sometimes students do mistake over here. This happens due to not reading the question properly or due to very hurry to solve the sum. D0 is your current year dividend or it is your last year dividend. Don't forget this. Am I right, boys and girls? D0 will be always your current year dividend or it will be your last year dividend. D1 will be your expected dividend or the next year dividend. Expected dividend or it will be your next year dividend. One more thing, whenever the question is asking you to find out the D1 or D0, that is dividend per share. If the question is giving you dividend payout percentage, excuse me, if the question is giving you dividend, sorry, if the question is giving you, if the question is giving you dividend payout percentage, dividend payout is always from EPS. If the payout percentage is given, you need to multiply with EPS, EPS into dividend payout percentage, into dividend payout percentage, you will get DPS, that is dividend per share. But if the question is giving you dividend percentage, look to the question very properly, and you will get DPS is equals to face value multiply with dividend percentage. You need to take the face value of equity share. Do remember this two things very nicely and properly, because there are chances of doing slight error, minor error. If you want to find out dividend per share and if the question is giving you dividend payout percentage, always multiply with EPS. And if they are giving you dividend percentage, multiply with the face value. D0 is your current year dividend or the last year dividend. And D1 is your expected dividend or the next year dividend. Now we need to find out we need to find out the intrinsic value of the share. We need to find out the intrinsic value of the share. Intrinsic value of share is the market price. Am I right? The fair market price, the true market price is known as intrinsic value per share. Am I right, boys and girls? Now, how do you find? The formula as per Gordon's model is P0 is equals to D1 upon KE minus G. Here we know KE is 12%. D1 will be expected EPS. See the formula properly. See the words properly. They have told expected EPS. It is not current year EPS or last year EPS. It is expected EPS. So expected EPS multiply with dividend payout ratio. Multiply with dividend payout ratio or percentage. You will get D1. So your D1 will be 20 into 25 percentage. And 20 into 25% is nothing but D1 will be of 5 rupees per share. So we'll write down here 5 rupees per share. 0.12, 12% is my KE, and we need to calculate the G. Now what's the formula of G? G is growth. And how to find out growth percentage? Growth percentage is equals to B into R. B is your retention percentage. Retention percentage, and R is your ROI. Now since the dividend payout ratio, as the dividend payout ratio is 25%, I can write over here. Just have a look. Since dividend payout percentage is 25%, that means retention of the company will be 75%. Out of EPS, 25% will be distributed as dividend and 75% will be kept by the company and in form of retained earnings. So of course retention here you can find out G is equals to your retention will be 0.75, that is 75%, and the ROI is 15%. So you will get 0.75 into 15% as 11.25 percentage as the growth of the company. So I got my G percentage and write down 0.1125. 5 divided by 0.12 minus 0.1125, you will get divide by 0.075, 0.00 if I am not wrong, 0.0075, and 5 divided by 0.0075, you will get something 66 your market price, intrinsic market price will be 666.67. It is recurring per share. Am I right? But they don't want this answer. What they want, that if the dividend payout changes, if your dividend payout becomes 50%, then what will be the market price? We need to calculate again. Then D1 will change because 20 rupees is my EPS. If dividend payout is 50%, my D1 will become rupees 10 per share. Am I right, boys and girls? Even my growth rate will change, my G will change because my B will change. My retention will become 50%. Since my dividend payout is 50%, my retention will be 50%. Multiply with 15% is my ROI. So 0.5 into 15% will be 7.5% will be my growth. And if we put again in the formula, P0 is equals to D1 upon KE minus G. D1 will be 10, K will be 0.12, K expectation will remain same. Minus 7.5% will be 0.075. So 10 divided by 0.12 minus 0.075. You will get 0.045. So 10 divided by 0.0745. You will get something. Market price is 222.22. So what is the change in market price? The change in market price will be, of course, the change in market price will be 666.67 minus 222.22. So 666.67 minus 222.22. This will come to nearly around 444.45. There's a decrease in market price. And they have given us the option, there's a decrease in market price of 444.45. And the right option, if I'm not wrong, it's option B. Option B is the right. There is a decrease in the market price. So option second or the option B will be the right option. Very simple sum, easy to solve. This I've explained you via writing. In exam, you can easily solve in rough and you can get your answer in few minutes. Am I right, students? Say yes or no. Yes, students. Coming to your question number 3, we are done with sum number 3, sum number 2 completely. The right answer is it will decrease by 444.45. Now coming to question number 3, it is on your cost of capital. Again, a very small sum, nothing much difficult, can be done very easily. Only the question number 1 was very huge in the entire RTP. Others are quite manageable and good sums, so nothing to worry about it. Let's come to question number 3. We'll solve together. Abhi Limited is an all equity finance company. Fantastic. Once I come to know the first line, all equity finance company, we used to say in class, when it is all equity, KE will equal to KO. Am I right? And the value of equity will be equal to value of firm. Do you remember, students, we used to speak in class that, and even students who have actually not physically attended in Ednovate the classes of FM, but one thing for revision, you can remember this thing. Whenever the question says it is an all equity firm, KE will be equal to KO, the cost of equity will be the cost of the firm, and the value of equity will be the value of firm. Very simple and easy to remember. It is considering the replacement, wow, of rupees 275 lakhs equity share with 15% debentures of the same amount. Current market value of the company is 1750 lakhs, means this is a, when it is all equity, the value of firm, the market value of the company is 175. That means the market value of equity or market value of firm is 1750 lakhs, 1750 lakhs. With cost of capital is 20%, that means KEKO is 20%. Currently, the current scenario, that is all equity finance company, the KE is 20%, KO is 20%. Value of equity and value of firm is 1750 lakhs. Am I right, boys and girls? Say yes or no. Further, EBIT are going to be constant and the entire earnings are going to be distributed in form of dividend. We know there are 4 assumptions to the, this is a question of cost of capital, but actually this is a question on capital structure theories. This is actually the question on capital structure theories, and the 4 theories which we have learned in the class and which is there in your module also, which is an important part. The 4 things are, one is your NI approach, second is your traditional approach, third is your NOI approach, and fourth is your MM theory. And all the 4 capital structure theory, there are 4 basic assumptions. And what are the four basic assumptions? There are only two sources of finance. It is debt and equity. Second, debt is cheaper than equity. KD will be always less than KE. Third, there is no taxation at all. However, we have learned under MM approach that if there is tax, what will be the effect on the value of firm? And that is why if you see here also there's a corporate tax rate of 30%. In MM approach, there are two parts, one with tax and one without tax. And there is one NOI approach. So there are four theories which we need to learn, which we have already learned in the class. Do have a small recap of the same. What will be the new cost of equity of the firm? I need to find out the new KE. So why new KE? Because we are finding, we are introducing debt capital to the firm, and we know as the debt capital is introduced, the expectation of equity will increase, definitely increase. So we need to find out the new KE. So how to find out? Just 2 minutes job. Have a look over here. We'll solve very easily. Question number 3. Actually, this is not on cost of capital. It is a combination of cost of capital and capital structure theories. The students who have properly seen the module, the ICAI material, you will find this area, MM approach in capital structure theory. In module, you will definitely find this area, and do revise it well, because this is one of the prime elements where ICAI is regularly asking questions on MM approach with tax, without tax. Now, one thing we know that if it is all equity company, we say it as unlevered. Am I right? And when it is equity plus debt, we say that the firm is levered. And we know the formula of both. Value of unlevered firm will be, since it is tax, it will be EBIT 1 minus tax upon KE percentage slash KO percentage. So why you are writing KE or KO? Because KE and KO both will be the same. Since it is all equity, unlevered means all equity. Am I right, boys and girls? So if it is all equity, my KE will be equal to KO, and I can write KE percentage or KO percentage. The answer will be one and the same. Now, what is the value of my unlevered firm? The value of unlevered firm is 1750. EBIT 1 minus tax 0.3, if I am not wrong, is the tax rate, 30%, divided by 20%. So why 20%? Because KO is 20% when it is all equity unlevered firm. So 1750 into 20% will be 350. 350 is equals to EBIT into 0.7. We'll take 0.7 on that side. Therefore, EBIT will be, I think so, 350 divided by 0.7. It will be 500 lakhs, if I'm not wrong. Yes, sir, it will be 500 lakhs. Am I right, boys and girls? So when the firm was unlevered, the EBIT will be 500 lakhs. The value of firm was 1750. The cost of KO or KE is 20%. But now the company is going to be levered. Am I right? And they are going to raise 275 lakhs in form of debentures. Am I right, boys and girls? Something debt capital has been introduced, if I'm not wrong. 15% debentures. The rate of interest is 15%. So one thing what I understand, first thing they have told that EBIT is going to remain constant. We can find out the value of the firm which is levered as per the MM approach formula. There is value of unlevered, that is value of unlevered plus debt capital into tax percentage. Now, as we know, as per MM approach, the value of levered firm will be greater than value of unlevered firm, and that is because of the debt capital. Debt is very beneficial for the company because it is a tax shield. Because of that, we can save the interest. We can save the tax because of the interest. Interest is a deductible expense, and that is why the value of levered firm will be always greater than unlevered firm only when there is a tax percentage. Debt has an importance in the capital structure only if there is tax. If there is no tax, the value of levered and the value of unlevered will be always same. The value of levered and unlevered will be always same. The value of unlevered and levered will be different only because of the tax element. And here also there is a tax element. That is why the value of levered and unlevered is different. Otherwise, it will be definitely same. Boys and girls, am I right or wrong? Okay. So my value of unlevered is 1750. My debt capital is going to be 275. The tax rate is 30%. So the value of levered firm will be 275 into 30% is 82.5. So 1750 plus 82.5, it will come to 183, 1832.5. This will be my value of levered firm. Value of levered firm. Do you all agree, boys and girls? Now, one more thing we need to find out. If the value of levered fund is 1832.50, value of debt we know. What is the value of debt capital? Of course, it is going to be 275 lakhs. So I can find out one more thing, that is value of equity. And if I'm not wrong, the value of equity will be value of firm minus value of debt capital. So it will be value of firm is 1832.5 minus 275. So the value of equity will become 1557.50 lakhs. If I want to find out the cost of equity, that is K, cost of equity, which is K, I can say dividend upon value of equity into 100. This is a formula as we have learned in the class, and with the help of this we can find out the cost of equity. Now, how to find out dividend? See, we have EBIT minus interest and 1 minus tax. I'll get the dividend. Am I right? Because there are only two sources of finance, debt and equity. There's no preference shares. There's a tax rate. So EBIT minus interest will be EBT. EBT minus tax will be EAT, and that will be the earnings or the dividend of the equity shareholder, because all earnings are distributed in form of dividends. There's no retained earnings. Even there's an assumption, if you know, and they have given also over here that all earnings are going to be distributed, means they are going to keep nothing in form of retained earnings, and that is why my EAT will be earnings available for equity shareholder, which will be my dividend. Is a yes or no, boys and girls? Divide by value of equity into 100. My EBIT is 500. The interest on debt capital will be 275 into 15%, which is going to be minus 41.25. This is the interest. 1 minus 0.30 divided by 155, 7.5 into 100. 500 minus 41.25 into 0.7 divided by 155, 7.5 into 100. You will get something 20.62. You will get KE as 20.62, and bingo, our answer is right. And so which option is correct? Option D is correct. How quick, how quick. If you know how to calculate the sums, if you know the approach, if you are able to identify the question, all the formulas and everything is known, well revised, it will be very easy to solve. Say yes or no. So option D will be the correct answer, and let's go to the next one. So reading your question number 4. Question number 4 is your working accounting ratio, and I love the questions on accounting ratio a lot. Why, sir? Because they are very easy. Because there are not much twists and turns what they can give to the accounting ratio portion, and this sum is also very easy. The trick to solve the accounting ratio problems are very nice. One thing, find out which is the absolute figure given in the question, which has a relation with the ratio. And once you use that data, all other links will be automatically developed in the question. So let us read the question. Of course, this question is also very easy. Ratio, this question has asked very easily in this RTP. Let us read the same. Vardhaman Limited gives you the following information related to the year ended 31st of March 2024. Am I right, students? Okay. What they've given the information, read the information properly. How much information is available? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 and 15 information. I need to read, or I need to use all this 15 information to find out one more information is tax rate. Okay, to find out these 5 items. What 5 items I need to find out? Quick ratio, fixed assets turnover ratio, debt service ratio, earnings per share, and price earning ratio. Price earning ratio is nothing but your P ratio. EPS, debt service ratio, fixed assets turnover ratio, and quick ratio. Means if I want to find out this 5 item, I need to use the above 15-16 information. What are the 15-16 information? Let us read one by one. First is your current ratio. Second is loan funds to own fund. Own fund is nothing but your equity shareholders fund. Am I right? There is nothing but your equity shareholders fund. Gross profit ratio, stock turnover ratio, net working capital, return on total asset pre-tax. Wow. They have told return on total asset, but they have told pre-tax. Pre-tax, very nice. MPS, market price per share, total asset turnover ratio, opening stock. Wow. Fixed assets, 75,000 equity shares of rupees 10 each. 25,000, 12% preference share of 10 each. Depreciation, interest on debt, future installment. Nice. Tax rate is 25%. So I don't want to enter into the requirement area first. You are required to calculate quick ratio, fixed assets turnover ratio, debt service ratio, earnings per share, and price earning ratio. I will start finding whatever I can find out with the help of this information. See, what information I can use is my current ratio and net working capital, because it has a ratio. Current ratio is current asset divided by current liability, and net working capital is current asset minus current liability. It has got a relation. So with the help of that information, at least I can start my journey. What do you say? In exam also, with respect to accounting ratio analysis, do this approach only. Information available, start using. You know the formulas. And as you have revised the formula well, definitely you'll end to the right answer only. Because this is the information and the answer is lying in this information only. So start using the data one by one, one by one. You will end up to get the answer definitely. So what I'll do, have a look. Question number 4 is on your ratio analysis. Question number 4 is on ratio analysis. And what we'll do, we'll use the first one. We'll prepare working note. Start preparing quickly working note. In exam also, the same approach is required to be followed. Current ratio. How much is the current ratio? 3:1. Am I right? What is current ratio? Current assets upon current liabilities. That means my current asset has to be 3 and my current liability has to be 1 by default. Am I right? Do you all agree? Now, what is your net working capital? Net working capital as given in the question is 5 lakhs. I sir agree with you. And what is your net working capital? Net working capital is CA minus CL. That is, CA is your 3, CL is 1. That means your net working capital is 2. Equation wise. Hope so you understand. Am I right? That means your net working capital is 2. Now, if my net working capital, simply I can find out very easily. I'm trying to explain you. If my net working capital is 5 lakhs, as per equation it is 2. So my current asset is 3. What will be my current asset? I can just simply cross multiply and find out 5 lakh into 3 divided by 2. My current asset will be 7,50,000. This is the quickest manner to solve the sum. So what will be my current liabilities? Yeah, so current liability is 1. So I can simply again cross multiply 5 lakh into 1 divided by 2. My current liability will be 2,50,000. If you agree, students, say yes or no. This is how I got my current assets. And this is how I got my current liabilities. Both the things I got at the first instance only. Very easily and very quickly. Current assets of 7,50,000. Current liability of 2,50,000. Wow. So first data used, net working capital used. Now since I have current asset and current liability, net working capital used, what next information can I go for? What do you think? What next can I go for? Sir, making a glance on the question, I have, if I'm not wrong, fixed assets. So I can say fixed assets plus current asset will be my total asset. So second thing I can write, total assets is equals to, I saw the question, it will be FA plus CA. I have a fixed assets of, given in the question as 15 lakhs. So 15 lakhs plus my current asset, I just calculated out 7,50,000. So it will be how much? 15 lakh plus 7,50,000, it will be 22,50,000. That is my total assets. And I can see one thing over here. There's a total asset turnover ratio. With the help of total asset turnover ratio, I can find out something. Total asset turnover ratio is nothing but sales upon total assets. I'll be able to find out sales. Wow. See, I told you now, one thing you find out, you'll get the other things very easily. So I have total assets over here as 22 lakhs. My total asset turnover ratio is how much? 2.5 times. So I can say 2.5 is equals to sales upon total assets of 22 lakh 50,000. Therefore, my sales will be 22 lakh 50,000 into 2.5. My sales will be of how much? 56 lakh 25,000. Yes, sir. And I can do one more thing, sir. Now I have got sales. I have used my total asset turnover ratio. I can see gross margin. Gross profit ratio is somewhat 25%. Wow. So I will use my 4 data. See, one by one, I am calculating everything very quickly. I can find out my GP margin. GP margin will be sales into GP percentage, and my GP percentage is how much? 25%. So sales is 56 lakh 25,000 into 25%. So my GP margin will be 14 lakh 6,250. I'll get a GP of 14 lakh. Someone check. Yes, sir. 14 lakh 6,250. And sales minus GP is nothing but COGS. So I can say 56 lakh 25,000 minus 14 lakh 6,250. Therefore, I can get a COGS. Always, whenever you have sales and GP, find out COGS. By default, it might help you somewhere. Yes or no? Minus 15 lakh 25,000. It will be something 42 lakh 18,750 as my COGS. You have the data, kindly use. Gross profit done. Just below gross profit, I can see stock turnover ratio. And in stock turnover ratio, we require COGS. COGS divided by average stock. Superb. Very nice. So fifth item, what will write down? Fifth item will be write down stock turnover ratio. And stock turnover ratio is nothing but COGS divided by average stock. So why you are using average stock? Since I have opening stock available. If I don't have opening stock, I will be using closing stock by default. Am I right? So your stock turnover ratio is how much? That is 10 times. Okay. My COGS is 42 lakh 18,750 divided by my average stock. Therefore, the average stock of the company will be 42 lakh 18,750 divided by 10. It will be 4 lakh 21,875. And I have opening stock. How do you get average stock? Average stock is opening stock plus closing stock divided by 2. Now average stock is 4 lakh 21,875. Opening stock as given in the question is how much? 6 lakh 50,500. 6 lakh 50,500 plus closing stock divided by 2. So if we solve this, we'll get a closing stock of how much? 1,93,250. Yes, sir. Wow, very nice. We are getting one item. 1,93,250. So what details you have used? So you have used stock turnover ratio. You have used opening stock. So now what next you can use? So I can see the sixth item, that is return on total assets. And return on total assets, I have total asset. They have given us return percent, that is before tax. Yes, sir, pre-tax. So return on total asset pre-tax. And we know the formula. If it is pre-tax, it will be EBIT. If it is post-tax, it will be EBIT 1 minus tax. So EBIT divided by total assets. How much is the return on total assets? It is 20%. So 20% is equals to EBIT upon total assets. Your total assets are how much? We have calculated total assets. Yes, we have total assets of 22 lakh 50,000. So we'll write down over here 22 lakh 50,000. Therefore, the EBIT will be 22 lakh 50,000 into 0.2, which will be your 15%. Sorry, my mistake. I saw 20%. That is market price per share. It it is 15%, and that is why 22,50,000 into 15% will be, your EBIT will be 3,37,500. Yes, I have one more information available. So I have used my return on total asset. Now I'll take a glance what things I have not used. Sir, I have not used loan funds to own funds. Okay, not a problem. Then we have not used the MPS. MPS will be used for P ratio. Am I right? Then we'll be using equity share, preference shares, depreciation, interest on debt, and future installment. Okay. So now one thing what we can do, we can use loan funds to own funds. It is a ratio of 1:3. Am I right, boys and girls? With the help of that, I can definitely find out. Now going ahead, there's a small mistake in this accounting ratio done by ICAI solution. If you see, they have given loan funds to own funds. Now if I use this data, loan funds, and very specifically they have wrote loan funds to own funds. There is a big mistake done by ICAI solution. Loan funds to own fund means what? Equity, and they have also written in their ICAI solution as equity. Just a second. However, they have made a big mistake. Now loan funds to own funds is something, I think so, if I'm not wrong. How much is loan fund to own fund? 1:3. That means, can I say loan funds? And what are loan funds? The debt capital. They have also told the rate of interest on debt capital is 9%. Means there's a debt capital upon own fund is your equity shareholder fund. Am I right? Equity shareholders fund, which is 1:3. That means if 1 rupee is debt, 3 rupees is equity. Am I right? So I can say very clearly over here that, can I say equity shareholder fund? Equity shareholder fund is equals to 3 debt. Just simply cross multiply. Now I can use one equation. Total liabilities is equals to total assets. Since I have total assets, my total assets are 22,50,000. I can find out this with the help of equation. But what will come in total liabilities? In total liabilities, we'll be having equity shareholders fund plus preference shareholders, preference share capital, plus debt capital, plus the current liability. There is a big mistake in this solution. They have not taken preference share capital, and the entire answer will change. They have used in the solution, if the students who mark properly, they have used the equation as total liabilities equals to total asset. However, they have forgotten, completely ignored the preference share capital, which is given in the question just below equity share capital. That the preference share capital are 25,000 of 10 each. There's a big blunder by the solution. Do have a look, and if in case of any doubt, do let me know, because we'll be having 3 things: equity share capital, preference share capital, debt capital, and the current liability. All these 4 items will comprise of your current liability, which will be all these 4 items will be comprising of your total liability, which will be equal to your total assets. Now ICAI has only considered equity plus debt plus current liability. Where is preference share? And the fun part of the story is, when they are calculating the EPS, they have reduced the preference share dividend. But while calculating liability, I cannot see anywhere preference share capital. So I think so there's a big mistake in the solution which has been drafted, because everything will change. EPS will change, MPS will change, many variables will change. So students, have a look on this question number 4. There's an error in RTP, which we have captured the same, which is equal to 20,50,000, which is total assets is my 20,50,000. My equity shareholder fund will be 3 debt, as we have just wrote right now, plus preference share capital is 25,000 shares of 10 each, so it will be 2,50,000, plus debt plus current liability is 2,50,000. We have already calculated in the first working note, is equal to 22,50,000. Now this will be 4 debt. 4 debt is equals to 22,50,000 minus 5 lakh, which will be 17,50,000. Therefore debt will be how much, sir? Divide by 4, I'll get 4,50,000 37,500 as my debt capital. My equity capital will be 3 times debt, so it will be 13,12,500. Now if we tally 13,12,500 plus 2,50,000 preference shares plus 4,37,500 my debt capital plus 2,50,000 my current liability, this will be the right thing. So do have a look. This is a small mistake because on this basis we are going to prepare a short income statement because we require EPS, and EPS we can get with the help of income statement, which is EBIT. I already have EBIT. How much I got EBIT just right now I calculated is 3,37,500. 3,37,500 minus interest on debt capital. Now interest will be on 4,37,500 into 9% is my rate of interest. 4,37,500 into 9%, it will be 39,375. I'll get an EBT. I'll get an EBT of how much? 3,37,500. 3,37,500 minus 39,375. I'll get 2,98,125 minus tax at the rate of, they have given on the last line 25% for this purpose only, into 25% minus is equal to, I'll get something EAT of 2,23,594 minus preference dividend, and the rate of preference dividend is 12%. So 2,50,000 into 12%. 2,50,000 into 12%, which will be 30,000, which they have rightly taken in the income statement. How they have forgotten to take over there, I don't know. So it will be 2,23,594 minus 30,000. It will be earnings available for equity shareholder, which will be 1,93,594 divided by number of equity shares, which are 75,000. So EPS will completely change. Your EPS will be divided by 75,000 shares. It will be 2.58 per share, and they are getting an EPS of, if I'm not wrong, 2.53. So there will be a small error of something 0.05. There will be a small error of 0.05. This is my EPS. Now I have EPS. I have many data. I have used my loan funds to own funds. I have used equity share capital. I have used my preference share capital. I have used interest on debt. Now I can go for my calculation part. That is, first of all, quick ratio. I'll go for quick ratio. What is the formula of quick ratio? Come on, quickly. Quick ratio is equals to current asset minus stock minus current liability. Oh, now how much is your current asset? 7,50,000. We got a stock of how much? We got a closing stock of something 193,250. Am I right? We have calculated 1,93,250. So 7,50,000 minus 1,93,250 divided by current liability of 2,50,000. And if I solve this, 7,50,000 minus 1,93,250 divided by 2,50,000, I get a quick ratio of 2.23. Yes, sir. It matches with my ICAI answer. Is 2.23:1. Now, what is the second thing? They have asked us fixed assets turnover ratio. Very easy. Fixed assets turnover ratio will be sales upon fixed assets. Sales upon fixed assets. Am I right? And my sales is how much? 56,25,000, if I'm not wrong. We have already calculated 56,25,000. Let me check for one more time. Yes, it is 56,25,000. And my fixed assets are 15 lakhs. So I can say 56,25,000 divided by 15 lakh. And we'll get how much? 56,25,000 divided by 15 lakh. We'll get 3.75 times. Very good. Very nice. Now, one thing is, it is debt service ratio. Now, what's the formula of debt service ratio? That is also very easy. Debt service coverage ratio. It is EBIT plus depreciation. That is why the depreciation is given in the question, divided by interest plus future installments. Am I right? And that is why they have given us installment also. If you see properly, my EBIT, I got how much? I got an EBIT of here only I have calculated 3,37,500. Yes, sir. It was 3,37,500 plus we have a depreciation. Here, this information will be used now. So plus 50,000 divided by interest is how much? The interest we have calculated just right now, it was something nearly around 39,375. 39,375, and the future installment is something, the 15th item, which is 2 lakhs. So plus 2 lakhs, and if we do this calculation, 3,37,500 plus 50,000, it will be 3,87,500 divided by 39,375 plus 2 lakh, which will be 2,39,375. Which will be 1.62. So this will come little different than your ICAI solution because of that error. And same will go for EPS. My EPS is coming 2 point, how much? I just calculated the EPS. My EPS is 2.58. Am I right? Per share. And their EPS is coming 2.53. The difference because of that preference they have not considered. And last thing what I need to calculate is my P ratio, which everyone knows that is MPS upon EPS. Your MPS is 20 per share and 2.58. So your P ratio will come 20 divided by 2.58, which will be 7.75 times. And they are getting 7.91 times. So this is the error which is required to be rectified. Do make proper correction to this solution and then go ahead. Am I right, students? Otherwise, the entire sum was very easy to calculate. Just look properly the variables which has a relation. In exam also, you do in the same manner and entire answer will be solved very easily. Yes, students, am I right? Yes, students, let us continue with the question number 5. We are done with 1, 2, 3, 4 completely. All things are properly understood. There was a small mistake in the accounting ratio. And let us continue with the question number 5 of your RTP. Question number 5 is your question from cost of capital, a very easy question. We are going to find out the KO, that is weighted average cost of capital, WACC, on the base of market value. So let us find out the same. Easy question, small thing to discuss, and then we can go ahead. The capital structure of the SAM Limited is as follows. There is 12% debentures of 3,50,000, 14% preference shares of 4,50,000, and equity shares of face value of rupees 10 each. So 8,50,000 is my equity share capital, and the total capital employed in the business is 16,50,000. Additional information: rupees 100 per debenture, redeemable at premium 6%. So one thing I know that the face value of the debenture is 100. They are going to be redeemed at. Premium with flotation cost 5%, rupees 100 per debenture, redeemable at premium of 6% with flotation cost of 5% and 5 years of maturity. The current market price of the debenture is 115. So 115 will be your net proceeds. Am I right? Rupees 100 will be your net proceeds, and 115 will be your net proceeds. One more time, I'm reading the first part for all of you. 100 rupees per debenture, redeemable at premium of 6% with flotation cost of 5% and 5 years of maturity. The current market price of the debenture is 115. So these debentures are redeemable debentures. I'll use the formula of redeemable over here to find out the KD. Then we have the second part, rupees 100 per preference share, redeemable at a premium of 10%, issued at a discount of 2% with a flotation cost of 5% on the issue price. The current market price of the preference share is 108. Its maturity is of 10 years. And equity share, so here we need to find out the redeemable preference shares. I'll get KP over here. As we know that for finding WACC we require KD, KP, KE, KR as given in the question. So I will require to find out KD, then I need to find out KP, and I have also information about KE, that is equity, An equity share has a flotation cost of 5 per share with a market price per share quoted rupees 30. Sam Limited paid last year, as we discussed in the previous questions only, last year dividend is your D0. So last year dividend is 4 rupees and the company is expected to give an annual growth of 9%. They have given you the G percentage is 9. Of course, when I see this D0, D1, of course, Gordon's model will be only applicable. The company has a practice of paying all earnings in form of dividend. Corporate tax rate is 25%. Calculate WACC using the market value weights. So let us look at the solution. This is being a very easy question for all of us. It is not like much difficult like question number 1 or what was there little bit in accounting ratio. So we'll directly jump to the solution and would like to only discuss with you, since it is an easy part which can be very easily managed. And also this is a mark scoring for students. If such type of questions do come in exam, it's balle balle for every students. Am I right, students? Say yes or no. So the solution for your question number 5th, have a look to it. What we need to find out? We need to find out KD, KP, KE, and with the help of that we'll find out the WACC using the market value weights. Am I right? They have very carefully told that use a market value weight. Now we know how to find out cost of debt capital, KD. Redeemable debentures are there, and formula for redeemable debenture is KD is equal to interest 1 minus tax plus RV minus NP upon N whole divided by RV plus NP divided by 2 into 100. Now if I'm not wrong, now this time they have given you very specifically in the question. Students normally have a doubt with respect to flotation cost. Okay, what will be the flotation cost? What will be the flotation cost? And flotation cost should be always calculated on the market price or the issue price. At what price we are issuing? On the net proceeds and not on the face value, because very specifically this time in the RTP they have noted in the solution part also that issue price will be the market price and know the face value. So flotation cost they have done on 115 only, the net proceeds, and not on the face value of 100. So students, make a note, whenever it comes flotation cost, kindly take on the issue price and market price and not on the face value, because very specifically in the RTP also this time they have noted the same and told if the question says that find on face value, then only find on face value, otherwise no need to find on face value. So what will be the interest amount? Interest will be always on the face value. Do not forget, any interest, any dividend, interest on debt capital, dividend on preference share, dividend on equity share will be always on face value. So 100 is my face value and the rate of interest is somewhat, if I'm not wrong, 12%. The rate of debentures what we are issuing is 12%. Am I right? Yes sir, the rate of interest is 12%. So 12 rupees will be my interest. Now talking about redemption value, they are going to redeem at par. Sorry, they are going to redeem at premium. So 100 plus 6% is the premium. So 106 will be your premium, the total redemption value. And the net proceed, what do you mean net proceed? The amount received by the company from the debenture holder. See, we are issuing at 115, but there is a flotation cost of 5%. So I need to reduce the 5% from the same to find out the net proceed. So 115 minus 5% will be 109.25, which will be my NP, that is net proceeds. And simply using the formula, as we all know the formula, I'll get the KD amount, which is 7.76. So this is the important thing. Number of years also they have given you 5 years. And keeping all thing in mind, understand, always interest on face value. Flotation cost will be on the issue price or the market price at which it is issued. Here the face value is 100, but the company is issuing the debentures 115. So flotation cost will be always on the issue price or the market price and not on the face value, very clearly told in RTP also. And we shall also follow the same in the exam. If you find any confusion, kindly write the note at the end that face flotation cost has been calculated on the market price or the issue price. Clear to all? Now talking about your redeemable preference shares, these are also redeemable. So we know the formula KP is equals to dividend plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. And what will be the dividend? Dividend will be on the face value. What is the face value of preference share? 100, and dividend rate is 14%. So if I'm not wrong, your dividend will be 14. Yes sir, dividend will be 14. Number of years for redemption, if I'm not wrong, maturity is 10 years. And the redemption is going to be at 10% premium. So RV will be 100 plus 10%, which will be 110. But talking about NP, that is net proceeds, we are going to issue at 2% discount, and there is also flotation cost of 5%. So if you are issuing a discount, 100 minus 2% will be, of course, by default, how much? %, preference shares redeemable at premium, issued at discount on the issue price, and the market price is 108. It will be not on 100 because they have issued at 108. The face value is 100, but the issue is on 108. So NP will be 108 minus 2%, which will be 105.84. They are issued at 108 and not at face value. Out of this, minus 5% is the flotation cost. So your net proceeds will be 105.84 minus 5%, which will be 100.548, or you can take 100.55. Always see in the question at what price they are issuing. Sir, if the question does not say the issue price, take the current market price, because company will issue at the current market price and not on the face value. So if the issue price is not given, we'll take the market price. Now talking about equity, cost of equity, of course, Gordon model, K is equals to D1 upon P0 plus G. We know the growth rate is somewhat around 9% given in the question. Am I right, students? And D0 is 30. No, the market price is 30. So P0 is 30 and D0 is how much? D0 is 4 per share. So we'll say D1 will be 4 plus 9%. 4 plus 9% will be 4.36, the expected dividend, divided by market price. But there's a 5 rupees flotation cost. So 30 minus 5 and plus growth of 0.09 divided by 25 plus 0.09 into 100. So you will get 26.44% as your KE. Am I right? And now you need to calculate the market value weights. Very simple to calculate market value weights. You have the cost percentage. Now how to find out the amount of capital? You find out number of debentures and multiply with the market price. See, everywhere the market price or issue price has been taken, and in that you don't need to reduce the flotation cost. So be aware, students many a time make a mistake over here. They reduce the flotation cost. You don't need to reduce anywhere flotation cost. Am I right, students? Yes or no? So simply you find out the number of debentures, number of preference shares, number of equity shares, multiply with the market price. You will get the weights, multiply with the cost, and we can calculate the WACC percentage. Simple, very simple sum to do. Nothing to bother much about this. Only small things which I told you to keep in mind should be properly understood. Am I right, students? Yes, students, going to the next question. Now in next questions, I have seen few students have certain doubts with respect to capital structure. See, whenever this type of question comes, where you need to find out which plan is beneficial, plan 1 or plan 2, whether to go for debt or whether to go for equity, because if I see the requirement, calculate the probable market price of the share, whether to raise the additional finance with the help of debt or whether to raise with the help of equity shares. See, 4 working notes you should always prepare. And what are the 4 working notes? First, prepare the capital structure. Second, find out the interest amount. Third, find out the preference dividend if the preference shares are there. And fourth, number of equity shares. See, I'll tell you how to go with this sum. For example, question number 7, if we are talking about question number 7. Just 2 minutes I'll take. Let me read for you the question first. What is happening? Question has given us what information? Ritu Limited is in expansion stage and provides you the following information. Profit, that is EBIT, less interest on debt capital. I can tell the debt capital currently what the company is having is 10 lakhs. First thing I have already calculated over here, says interest is 1 lakh divided by rate of interest, 10%, 1 lakh is the debt capital. EBT less income tax, this will be EAT, and divided by number of shares, I can say the equity share capital is of 5 lakhs. That is existing in the company currently on the basis of what information has been provided, and it is right now in expansion stage. They have not told after expansion what will happen, we don't know, but right now they're into expansion stage and this is the current position. So they have a debt of 10 lakhs, they have the equity share of 5 lakhs, equity share capital of 5 lakhs, and what other information? Earning per share is 5.6 and the P ratio is 10. Now the company has reserves of 10 lakhs and requires, see the word proper, requires rupees 5 lakh further for modernization. So currently the company also has reserves RNS of 10 lakhs. So if I'm not wrong, the existing capital employed of the business is around 25 lakhs. The existing capital employed of the business is around 25 lakhs, which is the total 10 lakh plus 5 lakh plus 10 lakh, 10 lakh reserves. Of course, they have told they have existing reserves. So don't forget, if you don't prepare your existing capital structure properly, you will be into a big trouble. So understand the question properly. Here they have the existing reserve of 10 lakhs, equity share capital of 5 lakhs, and there's a debt capital of 10 lakh, total existing capital employed of 25 lakhs. Am I hope so right about this? Further, they required 5 lakh for modernization. The further capital required is 5 lakh, and therefore the total capital employed after expansion, will be 30 lakhs. Hope so it is very nice and properly clear to all. So there should be no blunder over here. Now return on capital employed is constant. Now why need to find out the existing capital employed? See, ROCE, return on capital employed, what's the formula? EBIT upon capital employed into 100. And if you see the existing EBIT of the company is somewhat 5 lakh. This 5 lakh they are earning on existing capital of 25 lakhs. So if you don't find out the existing capital employed right, your ROCE will be wrong. So if I say 5 lakh divided by 25 lakh into 100, the company is currently earning 20% on the capital employed. And if the question is silent, it is not saying what will be the future ROCE. This will be same continued on the next capital employed, the expanded capital employed. So if I say, what does the question say? I don't know. Question is saying it is constant. That's good. Means after expansion also they are going to earn same ROCE. So my new ROCE will be 30 lakh into 20%, which will be 6 lakhs. See how I'm dealing with the question. Have a look. I'm talking to the question continuously. So in exam also, when you solve the question, finally write something in your rough sheet. Rough sheet means at the last of the answer sheet that these things are given. So as you start writing, you have everything in hand. And you can simply put in your main solution. Am I right, students? Say yes or no. Okay. Now debt, that is debt upon equity ratio, is lesser than 2, will raise the P to 12. Means if the debt equity ratio is less than 2, P will increase to 12 times, and if it is less than 2, it will be same 10%. Interest rate on additional fund will be 12%. You are required to work under the probable price of the share. Now coming to the solution, it will be very easy for us. We have read the entire question. Come to the solution part of the question. And what does the question says? Little down. Yeah, I'll get this here. See, plan 1, if the 5 lakhs are raised as debt, and plan 2, if the 5 lakhs are raised by issuing equity share. See, I got the EBIT 6 lakhs. Now we know the format. EBIT minus interest, EBT minus tax, EAT divided by number of equity shares. I will get the EPS multiply with the P ratio, you will get the market price. So I have the existing interest of 1 lakh. Additional interest will be, new interest I am getting at 12%. So 5 lakh into 12% will be 60,000. So here it will be 4 lakh 40 and 5 lakh, that will be my EBT tax. After tax, I'll get EAT. Divide by number of shares. Now if no new equity shares are issued, my existing equity shares are 50,000. But if new equity shares are issued, kindly check properly, the new equity shares are issued at ruling market price, and the ruling market price we need to find out. Now how can we find out ruling market price? See, normally P is equals to MPS upon Normally, how do you find P ratio? P ratio you can find out MPS upon EPS. You have PE of 10, you have EPS as 5.6, and that is why your market price will be 56. So if you want to issue new capital of 5 lakh, divide by 56, it will be 8,929 shares plus the existing of 50,000. So your new capital base of equity shares will be 58,929. How did I use this? From the existing data. I have P ratio, I have EPS, I can find out the market price. That will be the current market price on the basis of information provided by the company. On that price, the company will issue the equity shares. So the new equity shares will be issued, that are 8,929 plus the existing 50,000. So total 58,929 shares will be issued. With the help of this, you will get the P ratio, and the most important part over here to find out the price earning ratio. Now check properly in your 30 lakhs. In your 30 lakhs, if we are issuing additional debt, our earlier debt was how much? 5 lakhs. Am I right? New debt will be again 5 lakhs. So 5 lakh plus 5 lakh. Sorry, old debt was 10 lakh. Old debt was 10 lakh. New debt is 5 lakh. So total it will be 15 lakhs. Old debt was 10 lakh. If I issue the new debt of 5 lakh, total debt will be 15 lakhs. So out of 30 lakh, if 15 lakh is my debt capital, so 15 lakh divide by 15 lakh, it will be 1. If I am not wrong, have a look to the calculation also. They might have also done the calculations over here. Yes, the debt equity ratio is 1. As the debt equity ratio is less than 2, P will raise. Question has told very clearly, if the debt equity ratio is less than 2, we need to increase the P to 12. And since our debt equity ratio is less than 2 times, 10 lakh was my old debt, 5 lakh is my new debt. So out of 30 lakh, 15 lakh is a debt. So 15 lakh will be the equity. So ratio will be 1:1. And if the ratio is 1:1, it is less than 2, my P will be 12. What will be the new? In new, 10 lakh will be the old debt. New debt we have not issued only. So 10 lakh divide by 20 lakh, and when if we do 10 lakh divide by 20 lakhs, it is 0.5. Am I right? It is, if I am not wrong, someone check. Yes or no? Okay, if it is less than 2, it will raise the P to 12. Am I right? So here it will be, of course, since I have 10 lakhs of reserves, 5 lakh and 5 lakh, 20 lakhs. So equity is 20 and debt is 10 lakhs. Am I right? So debt equity ratio is not much higher. If I am not wrong, debt is more and equity is less in the first case. So here it will, the P ratio will be 10 only. And if you multiply EPS with P ratio, you will get the market price per share. Am I right? Yes, students. So this is also perfect. Yeah, as in the plan 1, perfectly. As in the plan 1, if debt equity is less than 2, P ratio will increase to 12 in plan 1. Yes, sir. Here the debt equity ratio, debt ratio is lesser than 2. Okay, the debt equity, not debt ratio is lesser than 2. That means here the equity is more. Yeah, perfectly right. So the P will be 10%. Am I right? Yes, students? Yes. In the previous question, don't forget the debt equity ratio is less than 2. In the part 2, my equity is more than debt. That is why my P is not changing. In the plan 1, my debt and equity ratio is 1:1, which is less than 2, means equity is lesser than 2. The interpretation should be that equity is lesser than 2, and that is why the P is staying constant at 10. Now coming to question number 7, very easy question of the leverage. I think so this type of question should come in exam. If one difficult, one easy, so students can balance out very nicely and properly. And if both are easy, of course, win-win situation. From the following financial data of the company X and Y, prepare income statement. Now I know how to prepare the income statement. Sales minus variable cost contribution minus fixed cost EBIT minus interest EBT minus tax EAT minus preference dividend, earnings available for equity shareholder divided by number of equity share, EPS multiplied with P ratio, market price per share. So I know how to find out income statement. Always use the data which is available. Calculate margin of safety for both the companies. Okay. One thing what I know is if I have DOL is 1 by MOS. There's a reciprocal relationship between MOS and DOL. So if you want to find out margin of safety, definitely DOL will be 1 upon MOS. Calculate percentage change in EPS for both the company if the sales changes by 25%. Here the formula of DCL can be used because the DCL explains the relationship between EPS and sales. The formula of DCL is percentage change in EPS upon percentage change in sales. Okay, first we need to find out the income statement. What information do we have? For company X, company Y. For company X, we have 72,000 as variable cost, fixed cost of 35,000, interest of 12,000, financial leverage, income tax rate 13%. Sir, why did you become excited on this thing? I got my crust. I have financial leverage, I have interest. What is the formula of degree of financial leverage? I'm doing for company X. I'll just give you the hint for the same. It's a very easy sum. Whenever you find a combination, a connection between two items or two variables, use that point only because that will be the starting point. DFL is EBIT upon EBT. And we can say we have DFL of 4 upon 1, 4:1. So I don't have EBIT, but I can say EBIT upon EBIT minus interest because I have interest. And with the help of this, you can find out the EBIT. Once you get EBIT, see how I'm processing the sum. Once I have EBIT, EBIT plus fixed cost will be your contribution. And contribution plus variable cost, you will get the sales. Your entire income statement will be ready. You have sales, you have variable costs, you will get contribution minus fixed cost, EBIT minus interest, EBT minus tax, EAT. That's all what I wanted. So very easily you can find out the income statement. Once you get the income statement, you can find out DOL. With the help of DOL, you will get MOS. With the help of the same income statement, we will find out the DCL. Hope so, students. What I'm saying, this is a hint area. So this is how you need to approach your questions in the exams so that you can very easily solve the entire sum with minimum time. These are fantastic questions, very easy to solve. So how I approach, I found out the relationship between interest and financial leverage. I got EBIT. With the help of EBIT plus fixed cost, I'll go up in the reverse order in the income statement. I'll get the contribution plus fixed cost, plus variable cost, I'll get the sales. EBIT plus fixed cost, contribution plus variable cost, sales. Each and every item of the income statement will be done. With the help of that, I'll find out DOL. So I'll get MOS. With the help of DCL, I can find out percentage change in EPS because I know the formula of DCL and the formula of DCL, that's percentage change in EPS upon percentage change in sales. Now looking at company Y, what information do we have? So variable cost is 65% of sales. Okay, that means my contribution will be 35% of sales because there's a relationship between variable and contribution. Sales has two kids, one is variable cost, second is contribution. So if variable cost is 65%, contribution will be 35% of sales. So I can directly find out, see I have sales over here. So I have sales less variable cost, I'll get the contribution. Now after that, what do we have? We have operating leverage. What's the formula of operating leverage? Operating leverage is contribution upon EBIT. I have contribution, I have operating leverage minus fixed cost. We don't have fixed cost, but we can calculate the EBIT. With the help of EBIT, I'll get the fixed cost. And after that, I have what next? Interest expense, I have less interest. I'll get EBT minus tax. That will be your EAT. With this also, you will find out DOL. You will get 1 upon MOS. DOL is equal to 1 upon MOS. Am I right? Or MOS is equal to 1 upon DOL. Or you can say MOS is equals to 1 upon DOL. With the help of this, you can find out MOS. Do you agree? And then you can use DCL formula. Entire sum done. Very easy. Everything will be done very quickly. Just 10 minutes job. Hope so it is properly revised to everyone, students. Say yes or no. Yes, students. So leverage question was very easy, but we have one more good question. Actually, if you see in your RTP, till question number 4, there are little tricks and turns. But after question number 4, everything is very easy. So this is how your paper also is. Few questions are very easy. One question will be little difficult, which you need to manage. And even if your concepts are very nice and properly cleared, that won't be a great issue for any of the students. So out of 50 marks, I am very sure that if you have studied well, prepared well, you have done your writing practice, 40 marks is a minimum game which a student can achieve. But if you have good writing speed, you have practiced well all your sums, conceptual clarity, you don't need to worry, just be relaxed, don't take any type of stress. Okay, students? Yeah. Coming to a very small question, and so why you're laughing at this question? Because this question is very easy. If the questions are little lengthy and difficult, I become little serious because I need to explain each and every concept in detail why these things happen. But if the question is very easy, I'm relaxed. That student will be also relaxed. I'm also relaxed. Paper will be nice. Dividend decision. The following information is supplied to you. Particulars and amount. Total earnings are 4,50,000. Number of equity shares are 25,000. One thing what I can find out over here is retention ratio is 40 and MPS is 198. We have total earnings of 450. I can find out EPS. I see data and I popped up. I can find out the EPS. I think so EPS will be 18 if I'm not wrong. Do check in your solution. I have not seen the solution. I have seen nothing. I am just making out that yes, the EPS will be 18. What do you say, students? Have a look. Yes, so I'm damn sure. Yes, the EPS of the company is 18. One more thing what I see from this question is I can find out the ROI. Since we have total earnings and we have 25,000 shares of 100 each, so the equity share capital, if I'm not wrong, will be 25 lakhs. And if it's 25 lakh, I can find out the ROI, that is 4,50,000. That is 4,50,000 divided by 25 lakhs into 100. 4,50,000 divided by 25 lakhs into 100 will be 18%. Sir, you have EPS and MPS. What you can find out with this? Yes, sir, I can find out definitely something, that is my P ratio, and P ratio is MPS upon EPS. So it will be MPS is 198 divided by 18. My P will be 11 times. Fine, completely fine, not an issue. So now looking at the requirement, applying the Walters model. See, quickly I'll revise what 3 things are there in Walters model. If ROI is greater than KE, nothing to distribute. The dividend payout ratio will be 0%. If ROI is equals to KE, it is indifferent. You can pay out 100%, you can pay out 0, it's fine. But if ROI is less than KE, dividend payout ratio should be 100%. These are the 3 observations or comparisons of the Walters model. Now, first question what they are asking, analyze whether the company is following an optimum dividend policy. Now, how to find out KE? There is a relation of KE and PE. KE is equals to 1 by P ratio. So I have 11 times PE, 1 divided by 11 into 100. Your K will be 9.09. Your K will be 9.09. And if your K is 9.09, your ROI is 18%. What should be the optimum dividend policy? Is R greater than KE? Yes, R is greater than KE. 18% is of course greater than 9.09. And optimum dividend should be 0. Dividend payout ratio should be 0. Company is not following the optimum dividend policy. How, sir, do you know? Because the retention ratio is 40%. That means your dividend payout ratio is 60%. Means company currently is doing wrong as per Walters model. Since your R is greater than KE, you should not pay any dividend. So analyze whether the company is following optimum dividend policy. No. The dividend payout is 60%. It should be 0%. Okay. One thing we have understood, that no optimum dividend policy has been followed. Second, compute P ratio at which the dividend policy will have no effect on the value of share. See, dividend policy has no impact when ROI is equals to KE. Am I right? And we need to find out what's a P ratio. So if KE is also 18%, then ROI and KE is same. When ROI is equals to KE, dividend policy has no impact as per Walter's model. So, and we know how to find out, that means 18% is my KE, and if K is 18%, I can find out P ratio. P ratio is 1 upon KE. 1 divided by 18% will be 5.56 times. So, my P will be 5.56 times. If the P is 5.56 times, K will be 18%, and there will be no impact on the dividend decision policy. Third, will your decision change if P is 4.5? Analysis. If P is 4.5, my K will be 1 divided by 4.5. My K will be 22.22%, and if my K is 22.22%, boss, my K is greater than ROI. My ROI is less than KE. Here the dividend payout ratio should be 100%. The company should not retain anything. All should be distributed in form of dividends as per Waddell model. See, such a small question, actually, this might come for maximum 5 marks, not more than that. And it's coming for 5 marks. Win-win bonus situation. Am I right? Say yes or no, boys and girls. Now, students, coming to the most important area. Why is it an important area? Capital budgeting sums are always asked in exams. Capital budgeting sums are always favorite of the ICAI. But this time, what RTP question is there? What I feel, the person who has drafted RTP has been drafted RTP in the favor of students. All assumption, all notes, everything is given so proper that if the student is solving the RTP, there will be no if and but. Student don't need to make any assumption. Means there are certain assumptions, means loss on tax, tax saving, what will be the tax rate, because short-term capital gain, long-term capital gain, there are different rates. And while solving FM paper, yes, we know you are direct tax students. You are appearing your CA inter exam, you have a direct tax as a subject, we know everything. But certain things are required to be clarified in the question. And I am very happy this time this has been clarified in the capital budgeting question. See, very nicely I want to explain you this question. It will take only 5 to 10 minutes. Sir, why? Because it's an easy question, not a very difficult capital from capital budgeting. First thing, here we need to solve as per NPV method. And Ednovate students or being non-Ednovate students, my one small request is NPV has got only 3 steps. Any sums to solve on NPV method has only 3 steps. Calculation of present value of cash outflow, calculation of present value of cash inflow, calculation of net present value, and you find net present value as PVCI minus PVCO, present value of cash inflow minus present value of cash outflow. So how to find out outflow? Whenever you see the question of capital budgeting, boss, I'm very damn sure how to solve this question. Always think what are the expenses that are going to be incurred at the start of the project. That will be your present value of cash outflow. And what inflows are going to be received at the end of each year during the life of the project. You need to discount them to the present. It's very simple. You think what is outflow, what is inflow. What are the things outflow at the start of the project will be a present value of cash outflow. And in the future, means as the project is starting at the end of year 1, 2, 3, 4, revenue income minus revenue expense, you will get your cash inflow. Very simple, very simple. Keep it very straight and forward while solving this question. Don't think much about this capital budgeting because it's very simple. The path is very clear. Go accordingly, you will get the right answer. Now let me read the question, and while reading the question, see what things we take up. A company is considering the proposal to take a new project which requires an investment of 850 lakhs in plant and machinery and 150 lakhs in capital, working capital. The project is expected to yield, that is earn, the following cash flow before depreciation tax. Means this is my EBDT, earnings before depreciation taxes, over the next 5 years. Okay, year 1, year 2, year 3, year 4 and year 5, amount in lakhs. The desired rate of return for the project is 14%. Means this is my COC percentage or my discounting factor. This is the bare minimum a company wants to earn. And the assets must be depreciated at 20% on return on value basis. Okay, WDV. The scrap at the end of 5 years may be taken as 140 lakh. The income tax rate is applicable to the company is 20%. This is the only asset in the entire block. Means once this asset is sold, we need to find out loss or profit on the asset. Because we know block method as per section 32 of the Income Tax Act. If the blocks comes to an end, we need to find out whether there is profit or loss on sale of asset. And one good thing they have told, see, this is required to be told in the question, even though we know that the capital gain tax is at 15%, for the capital loss. Means they are indicating also that there is a loss at the end. Fine. You are required to calculate the net present value of the project and advise the management to take the appropriate decision. Also calculate the internal rate of return and the desired factor for the project. I'm very happy they have asked the capital budgeting question, but it's a very small question. Now I saw in the starting only 850 lakhs is a capital investment and 150 lakhs is my working capital. So 850 plus 150, 1000 lakhs will be my project investment, will be my PVCO. Do check in the solution. Definitely my 1000 lakh is my PVCO. Let us go to the solution. Let us go to the solution. Very, very easily we can solve this area. It will just take 2 to 3 minutes. Yes, come to the solution part. Yes. So you have here. Yes, PVCO is 1000 lakh. Now, once I get PVCO, this is my PVCO. We'll find out the PVCI, present value of cash inflow. Here 1, 2, 3, 4, 5. We have EBIT, that is earnings before depreciation tax. Now here you need to find out depreciation as per WDV. Don't forget, this is block method. Block method always follows WDV. Since an income tax students, since an direct tax students, you know about this. You will find out the depreciation. Depreciation will be reducing every year. You will get net profit before tax, less taxes, net profit after tax. Add back the depreciation to find out the cash inflow. Don't forget, at the end of 5th year, you will be having your working capital, that is 150 lakhs. Also, there is a scrap of 140 lakhs that is required to be added. Am I right? And you will do the discounting at the rate of 14%. This is known by you, nothing to worry. Only one important point what I want to tell to you is about the capital gains. This is a new point, not a new point, but many students are not aware or they might skip this point. So I want to highlight this point for each and every student. Other things you will be able to do very nicely. You will be able to solve IRR, I know. You know PI formula also, that is disability factor. But if you see over here, the WDV at the end, when you prepare the depreciation schedule, you will get the WDV at the end, that is 5th year, 278.53. And the sale value is 140. Am I right? The scrap value. So you are getting less than your WDV. So there's a loss on sale of asset. And if there's a loss on sale of asset, loss will save your tax. So in the last year, this 138.53 into 15% tax rate, 20.78 lakhs will be savings in tax, which should be reduced from the last year. Either to reduce from the cash inflow of the last year, how you add working capital, how you add scrap value, you can reduce the loss in the last year, or you can add to the NPV. My suggestion will be, they have added in the NPV, but my suggestion is just before your scrap or after the scrap, you write down less. Last year at the end of 5th year, there will be loss on sale of asset, capital asset, loss on sale of capital asset, and you take the discounting factor of the 5th year and your work will be done and you will get right NPV. This is the only point to highlight for you with respect to capital budgeting. Nothing much great thing, very simple, but do not forget to take the loss. Loss will be tax saving, and that is why it should be reduced from the cash inflow. Either you add in the last year in the NPV, either of ICAI is done, added in the NPV, you can add in the NPV, do consider the discounting factor of the 5th year. Otherwise, my suggestion will be you just subtract year only. How you are doing for working capital, how you are doing for scrap value, same manner you do for loss on sale of asset, tax saving. This is a highlight point to be considered. Otherwise, you know how to find out IRR. For IRR and YTM, we have also uploaded one more video on our YouTube channel. So if you don't know YTM or you don't know how to calculate IRR, you can see the YouTube link is available on Ednovate channel. So there you can see how to calculate the IRR. IRR is with the help of interpolation. So at 14%, if I'm getting the NPV positive, I have to take a jump. If my project is earning more than 15%, by trial and error, I can find out the IRR. And here the IRR of the company is coming somewhat around, at what percentage? 18%. So it is between 14 and 19%. Normally you can take a jump of 2 to 3% to find out IRR. And disability factor is nothing but your PI factor. So entire sum of capital budgeting will be also very simple for all the students who are trying this sum. Okay, students? Yes, students, coming to the last question of your RTP, which is from receivable management or working capital, whatever you say, because normally it comes in working capital only. It is more tilted towards working capital. And what this question is saying, it is very easy. This type of sum we have also done in the classroom, and is on the same basis. It will take just 5 minutes to discuss with you. Have a glance what the question is talking about. Nirmoha Limited wants to avail short-term loan from the bank. However, the bank grants short-term loan by keeping collateral securities in form of account receivables. We keep our receivables, that is debtors, on collateral basis, and we take a short-term loan from the bank. A bank won't give us directly on the basis of value of receivable. They will do some analysis. Definitely, bank does not give anyone at without checking the receivables. Definitely, a bank is analyzing the receivables of Nirmoha Limited to identify the acceptable collateral for a short-term loan. Now, what is the condition? The current policy of the company is 3/10 net of 40. Now, I would like to explain one thing over here. That what do you mean by 3/10 net of 40? That means the current policy of the company is for 40 days. Current credit policy of the company is for 40 days. If the customer is making the payment within 10 days, then the company is giving 3% cash discount. Then the company is giving 3% as cash discount. Bank will lend only to the extent of 90% of the receivables at an interest rate of 12%. Only if both the conditions mentioned below are fulfilled, bank will keep 5% for cash discount and returns. Customers are not currently overdue for more than 5 days to the net period. Currently not overdue more than 5 days to the net period. My net period is 40 days. So bank is saying 40 plus 5. If the current outstanding of the receivable is not more than 45 days, bank will say yes, but it is not or condition, it is and condition. So plus average aging, that is average payment of the customer, does not exceed 15 days past the net period. Means average payment, the average payment is not more than 40 plus 15, that is 55 days. Means if the customer is not paying on an average more than 55 days, means it's paying within 55 days, that also customer is best. And if the current outstanding is not more than 45 days, that customer is also best. So current outstanding less than 45 days and average payment should be 55 or less than 55, then both the conditions will be fulfilled, and that will be applicable for receiving the bank loan, and 90% company will get loan minus 5% for the returns and reserve. Okay, but one more thing is there. If the above condition are not fulfilled, the bank will lend 65% of the receivable subject to reserve of 15%, and interest rate will be 15% on such accounts. The corporate tax rate applicable to the company is 25%. On scrutiny of the following receivables, following are the acceptable securities considered for lending. Now these are the lendings, means these are the receivables. We need to see which are good, which are bad. And if both the conditions are not satisfied now, one nice thing what is drafted in the question, if both the conditions are not satisfied, bank is ready to give you loan, but only 65% of the receivable. Check. So have a look to the question. It's a very nice question. First thing, what will the total amount the bank will lend and effective cost to the company? Okay, come to the solution. Yes, definitely we'll get the answer for the same. It's a very easy question, nothing to worry. It will just take 2 to 3 minutes to solve the entire question. And let us talk about the question. Come on, boys and girls. Very nice. Again, clearly, we are clear. Current outstanding should not be more than 45 days. And average payment should not be more than 55 days. Now, to lending at 90%, lending at 65%. If both conditions are satisfied, tick mark. But if both conditions are not satisfied, you will get 65% of the lending. Is the first thing clear? Okay, talking about DR1, debtor 1. His current outstanding is 37 days. So DR1 is applicable in the first case. Am I right? I will write down over here DR1, current outstanding and average payment. Yes, in current outstanding, because it is 37 is less than 45 days. Here it should be 55 days. Here also yes. So if both yes, it will come in the 90% category. Have you understood, students? Current outstanding should not be more than 45 days and average payment should be done within 55 days. So DR1 is having current outstanding of 37 and on past he has made average payment in 40 days. So both the conditions are yes, that is why he is eligible for 90% of the loan. Hello. If this both the conditions were not satisfied, he might fall in 65%. Now talking about DR2, 2548. Yes, 2548 both yes. So 90%. DR1, DR2 done. DR3, no. So 47 days, it is exceeding 45 days. That is why it is falling in 65%. Have you understood? Both the conditions should be fulfilled. Second, 10, 56. Sir, 10 is okay, but 56 is not okay. So 65%. Then 30, 30. Yes. Within 45, within 55. 39, 50. Yes, sir. Within 45, within 55. 55, 25. Sir, no, sir. So 65%. 44, 54. Yes, sir. 15, 25. Yes, sir. And 20 to 75. No, sir. So 37 over here. So total bank can give for the total receivable for 90% eligible is 4,54,000 and here 2,48,000. Now 90% of 4,54,000 will be minus keeping the reserve. Am I right? Minus keeping the reserve, 4,54,000 reserve of 5%, that is 22,700 minus 4,54,000, that will be 4,31,300 multiply with 90%, the bank will give 3,88,170. Here the company will keep, here the bank will keep 15% reserve, and after keeping 15% reserve, 65%, this is multiplied with 65%, this is multiplied with 90%, so the bank will give loan of 137.20. Now this is a loan amount. Bank is going to give a total loan of 388,170 plus 137,020, a total loan of 5,25,190. Now calculating about interest. Here it will be 12%, here it will be 15%. Am I right? So the interest amount will be this, and we know interest is a deductible expense. So effective cost, it will be interest 1 minus tax divided by loan amount into 100. So interest minus the tax divided by loan amount, the effective rate will come 9.59%. It is a very easy sum. Hope so you have understood. You need to check only two criteria, that the current outstanding is not more than 45 days and the average payment is not more than 55 days. If both the conditions are fulfilled, boss, the bank will lend you 90%. If both the conditions are not fulfilled, then they will lend you 65%. Am I clear completely on this part? All the sums are properly understood. Yes, students, I wish you very good for your exams. Study well, study hard. Any doubts, please let us know and stay focused. Thank you, students.